was $2.7 billion convertible senior note offering. Shares of Lucid, look at this, are now down 14% in the market. Pressure across the whole space with Workhouse, Lordstown, even Fisker down 3 to 5%. Ty?
All right, thank you very much, Kelly. Our next guest is getting his portfolio ready for next year and says some of 2021's laggards will turn into 2022's leaders. Jason Ware is partner and CIO of Albion Financial Group. Jason, welcome back. Good to have you with us.
Good to be here, Tyler.
You've identified about a half dozen stocks that have not performed particularly well this year. Some are up, several are down, like Disney, Fiserv, and Visa. What were their problems this year, and why do you think that this group are now poised to turn around next year? What will the catalysts be? I realize they're probably individual to each company.
Yeah, they are individual to each company, but it's an important question. And I think one of the themes that that cut across all of them is that the businesses have done quite well this year, but the stocks have underperformed the market on a relative basis. In some cases, we're seeing negative returns, Disney being the most notable, down 15%, while Amazon and Starbucks are up close to 8%. But I think what we're seeing across these companies are unique concerns in different ways, whether it's Starbucks and the concerns since the spring around cost inflation, growth in China, supply chain concerns, whether it's the established fintech players like Visa, Fiserv, and PayPal that have been running up against Wall Street, wringing their hands over emerging fintech like Affirm and Afterpay and Square. These have all had some overhangs on the businesses that have lowered expectations for growth rates, but we think these are still businesses you can own in stocks that will play catch up over the next year or two as some of those concerns roll off and the businesses do fine.
So let's pick a couple of these companies apart and zero in on what you think may turn in their favor next year. Let's start with Disney. I assume that part of the thesis would be that worries over virus variants is going to recede and people are going to come back to the parks.
Yeah, that's right, Tyler. So I think the concerns over Omicron and another economic shutdown are certainly overdone. We've seen news that has corroborated that. So Disney is underappreciated on Wall Street. It's under-owned. We need to look at the stock since March and look at the prior months to that, actually, the 5 months going into March. The stock had gone up 75% once we got early news that vaccines were going to work last fall. And then we saw that amazing growth in their direct-to-consumer channel with regards to Disney Plus. That pushed the stock up dramatically real quickly. And we've had some consolidation since then, in part because we've seen a rolling wave of Delta infections and then concerns over Omicron. As we get into 2022, we expect people to come out in earnest, and we think the parks will overperform the street's estimates, and we think there's a nice move up in the stock based on a stable Disney Plus business and a growing parks and resorts business.
Let's look at Starbucks. Here, there are a couple of things. One would be commodity costs. The price of coffee has gone up. I assume they've passed much of that through to their customers. And there's also China, which is a questionable area, I suppose, for any company these days. What do you see being the catalyst there that could turn Starbucks upward more? And today, of course, we're seeing labor activism in Buffalo and elsewhere.
Right. Two things that we like about Starbucks as we look out over the next year or so. One is, as you noted, they are raising prices across the menu. And given their brand loyalty, we believe those price increases will be sticky. Meanwhile, our expectation is that the cost inflation abates in 2022 and beyond, and that will result in margins being driven higher for Starbucks. Meanwhile, it's still an economic reopening story, and it's a market share story. Unfortunately, there have been a number of small businesses that have closed in the coffee arena during the pandemic, and Starbucks has picked up a lot of incremental traffic as a result of that. So Starbucks is still a strong consumer growth story. It's only up 8% this year. And when you value it relative to, say, McDonald's, which we think is a nice, reasonable comparison, it actually has a $60 billion lower market cap, but they do $7 billion a year in higher sales. And those sales have doubled over the last decade while McDonald's has stagnated. So we think it's a nice relative value play, a high quality consumer growth story within that space.
We've talked individual stocks. Let's talk market broadly. Just very quickly, what kind of 2022 are you looking for?
Yeah, the setup looks really good going into 2022 as far as the economy is concerned. I think the markets have had obviously a big move off of the bottom. So maybe you need to restrain your expectations for returns going into 2022. But the setup looks okay. We're probably going to see a little more volatility due to the Fed accelerating taper and questions around inflation and interest rates. Nevertheless, the direction for the economy and profits look good, which means stocks should do okay.
Jason Ware, thank you very much. We appreciate your time as always.
Pleasure.
Americans aren't letting the Omicron variant stop them from going shopping, from traveling, and from attending concerts. That's according to the latest All America survey, and it could have implications for stocks and the economy. Steve Leisman joins us with the results. Steve?
Yeah, Kelly, good news for retailers as the holiday shopping season swings into high gear here. Americans are showing dramatically less concern about venturing out and ready to return to the mall. The CNBC All-America Economic Survey finds that the percentage of Americans who are worried about doing things like going to the mall, riding on airplanes, or visiting big cities has fallen, in some cases, by half compared to last Christmas. For example, there was a huge drop you can see there, 26-point drop among those worried about going to large events like concerts. A year ago, 36% of respondents said they were concerned about going to the mall. That's fallen to 23%. And good news for small business owners, the percentage of Americans worried about going to your establishments remains the smallest of all. That's on the right side of your screen there. The survey of 800 Americans taken December 1 through December 4. So it should incorporate attitudes about the Omicron variant. Better news here, while people are concerned about inflation and even downbeat on the overall economy, holiday spending plans up 13% compared to last year at $1,004. It's the highest we've seen in 3 years. Still, about half of Americans say they're going to do a lot of their shopping online. That's down from last year, but still above the 2019 level. We'll see how much of that endures if we ever get back to normal. And the survey found that in almost every single category, those who are vaccinated are still more reluctant to venture out than the unvaccinated. Kelly?
Well, it seems like everything, also has a political tint to it these days. Do the survey results reflect that?
Yeah, for sure. When it comes to venturing out, first of all, Democrats, a larger percentage of Democrats are vaccinated than Republicans, with, of course, independents, as they always are, in the middle. But take a look. You can see that when it comes to doing things like going to the mall or venturing out, overall, Democrats are more concerned than Republicans by about double. They're less concerned than they were a year ago, but still more concerned than Republicans overall, Kelly.
All right, Tyler, Steve,
I'm right here.
Thank you very much, Steve Leisman. We appreciate it. Ty.
All righty. Coming up, a Power Lunch exclusive with the CEO of CVS. The stock moving higher on an upbeat outlook and growth plans that include an expansion beyond drugstores. Plus, JP Morgan says Exxon will shine again in 2022. Does our Trading Nation team agree? They will share their best big oil ideas for the new year. Well, welcome back to Power Lunch, everybody. Shares of CVS Health climbing today on the back of bullish comments coming out of its Analyst Day. The company saying sales will accelerate in the year ahead, boosted its forecast, will resume share buybacks, and increase its dividend. It is the first time it's raised the dividend and repurchased shares since way back in 2017. Bertha Coombs is live with the CEO, Karen Lynch, in an exclusive interview. Hi, Bertha.
Hi, Tyler. Thanks very much. And Karen Lynch, thank you so much for joining us. You talked a lot today about how CVS is really going to focus on primary care. How much did the COVID pandemic really lead to this major shift?
Hi, Bertha. It's so nice to be with you. You know, the pandemic really played an instrumental role in how we thought about meeting consumers where they need to be met. If there's one thing that we learned throughout the pandemic, that people really changed the way they accessed care. They were accessing it virtually. They're accessing it in the communities, in our CVS locations, and obviously the dramatic changes in digital. So as we thought about the care delivery, and remember, we've been doing primary care services for many years. We've been doing episodic care. We moved into chronic condition management. This is a natural extension for us to really be part of our overall strategy to deliver care in the communities while at the same time being in the home and delivering it virtually.
But one of the things you really want to do is bring in doctors, because a lot of your clinics have more physician assistants or nurse practitioners, and there's such competition for doctors now. You're not the only ones wanting to do this kind of value-based primary care. How are you going to be able to bring in enough doctors when you're competing with private equity firms buying up practices, hospitals, and even some of your insurance competitors?
You know, we were very clear in our strategy today that we really need to look at this from a partnership or an acquisition. So as we think about expanding into primary care, you know, we'll be doing it through relationships with providers that exist today, or potentially doing an acquisition.
That's one of the things that some investors were a little concerned about, because you just relaunched your buybacks and, you know, giving back money to shareholders. What kind of an acquisition do you think you would make, and how would that impact that dividend and share repurchase?
Yeah, so we are committed to dividend. We were very clear today that we will be increasing our dividend, and we'll continue to increase it, you know, starting in 2022. We specifically did a share repurchase program and are committed initially to offset dilution. And then, you know, we'll continue to look at alternatives for capital deployment. We're not, you know, we said today we won't do a big acquisition. We'll do something that financially makes sense. And our CFO was very clear about that. That would make financial sense to us. And if it didn't, then we wouldn't do it.
You know, I want to shift and talk about the retail aspect these days. You're going to be closing 900 stores. At the same time, we are in a situation where we're seeing a lot of stores. Frankly, when I go to my corner CVS, there are a lot of things that are now behind a lock and key. Oftentimes there's some supply chain issues. How are you handling all of that? The theft risk and supply chain problems?
Yeah, it's a really good question. Well, let me just start with the 900 stores. We did an extensive evaluation to really de-densify where we were across the United States. So after we complete the reduction of those 900 stores, 85% of Americans will still live within 10 miles of a CVS location. Now, relative to your point about theft, that this is an organized theft problem. It has been ongoing. You're seeing a lot of it most recently with these grab and go kinds of activities. We are working extremely closely with attorney generals in the across the country in various states, and we're also working very closely with Congress to go after these organized crime. You know, they're criminals, and it is impacting our stores. And you know, what
impacting your bottom line?
Well, not substantially, not materially. What we are seeing is that we have to go after what they're doing is they're taking our products off the shelf and they're putting them online, and we need to go after that.
And are you getting cooperation from some of those online platforms?
We are getting cooperation. We're having those conversations. We're getting cooperation with the AGs. We're getting cooperations. You saw Congress was making a real push at this today.
Karen Lynch, thank you so much for joining us. Really appreciate it.
Thank you, Bertha.
And Kelly, we'll throw it back to you.
Bertha, thank you so much. And thanks to Karen Lynch as well. And Tyler and I were just saying we can really see the transformation of CVS before our eyes.
Absolutely can. The one that I frequent in a town in New Jersey has become the footprint of the healthcare is much bigger in the store.
It's where I've gotten flu shots and boosters. It's now the first place I think of for a lot of that. Very interesting. All right, will AR and the metaverse drive the next leg of growth for Apple as the company flirts with a $3 trillion valuation? It's just a hair beneath that level. And changes in the sky, from American trimming its international flights to low-cost carriers trying to steal share. Phil LeBeau is all over the story. Phil?
Hey, Kelly. Hello to you from Anchorage, Alaska. You might be saying to yourself, why would anybody go to Anchorage, Alaska in December? What if you had to do a layover here on the way to Asia? Well, one airline that plans to start up thinks that's a good idea. We'll tell you why when Power Lunch returns.
Welcome back. I'm Rahel Solomon, and here is your CNBC News update at this hour. Within the last half hour, President Biden began a call with Ukrainian President Volodymyr Zelensky as part of an effort to demonstrate U.S. support for the country as thousands of Russian troops gather near its border. Biden has warned Vladimir Putin that the U.S. and its allies will respond with strong economic measures if those troops go into Ukraine. 14 Republicans voted with Senate Democrats to set the stage for an increase in the nation's debt limit. Today's move will allow Democrats to raise that limit in a later vote without any Republican support. If the debt limit is not increased, the U.S. will default on its debt for the first time ever. Liz Cheney says that the January 6th committee's investigation is firing on all cylinders. Republican vice chair of the panel tweeted that it has met with more than 300 witnesses, including what she's described as 4 key figures today. And the International Olympic Committee says that boxing and weightlifting could be dropped from the 2028 Olympics in Los Angeles if their governing bodies don't move decisively to stamp out corruption and doping. You are now up to date. Tyler, I'll send it back to you.
All right, Rahel, thank you very much. Boeing and American Airlines trading lower in today's session. Delays in Boeing's production of its Dreamliner forcing American to reduce its international flights next summer. Let's get to Phil LeBeau now with the details on this and more. Hey, Phil.
Hey, Tyler, this announcement from American Airlines came out this morning after a report from the Wall Street Journal detailing how delays in the 787 Dreamliner deliveries that were scheduled are forcing American to alter its plans for the summer of 2022. Specifically, American will be cutting its international destinations, either pulling back completely in some cases, like dropping service to Edinburgh, Scotland, or in some cases, reducing schedules maybe to Beijing, Sydney, those types of destinations in Asia. The result, American Airlines trading lower. As for Boeing, it continues to have problems when it comes to getting the 787 Dreamliner to once again be delivered. Remember, it has been since the end of May that they have not been able to deliver the Dreamliners because the FAA has not signed off on the inspection process for Dreamliners before they can be delivered. That's the impact for Boeing and American today. Meanwhile, all of the airline stocks are lower. Now, when you look at this list of airline stocks, keep in mind that Southwest is specific to Southwest. They had an investor day. Negative comments from a couple of analysts. In fact, the downgrade from, I believe, Jefferies saying, look, we're not real crazy about the outlook that Southwest has presented to us. So all around, not a great day for the airline stocks. So you do see Alaska in the green. Guys, back to you.
So, Phil, I know we didn't send you to Anchorage to report about American, which is based in your town of Chicago, but you're there because a new airline wants to make inroads into trans-Pacific routes. Tell us about that.
Well, I'm also here for the weather. Look, we're talking about Northern Pacific Airways, which is a new startup airline. They're planning on starting service in the fall of next year. Look at the intended routes Northern Pacific intends to fly. This will be a low-cost airline from North America to Asia. The catch is you would do a layover here in Anchorage. So we're talking about whether it's San Francisco, LA, Orlando, New York City. You stop here in Anchorage. You may just do a connecting flight after a couple of hours, or you could spend a couple of days here, which is what Northern Pacific believes will happen. And then you go on to Tokyo, Seoul, and some other destinations. The question is, COVID-19 has really hit Trans-Pacific hard. Those flights are lower and lower and lower in terms of demand. We talked to the CEO of Northern Pacific. He believes that, yeah, it's a challenging time, but this is still a smart move.
Won't be quite perfect, and we might have to slide the date a little bit, but we're fairly confident because of the long lead time to start an international long-haul airline that we'll be in a different place by the time we're ready to go.
And again, they plan to start in the fall of next year with layovers here in Anchorage. Kelly, back to you.
Really neat idea.
Yeah.
And a reminder, even as Phil's standing there, how beautiful it can be, all of that snow. Dark, too. Phil, thank you so much. We appreciate it. Phil LeBeau in
It's daylight.
Anchorage.
The sun just came up here.
No, like Tyler said, happy hour must start at 1 p.m. in that part of the world, just to stay ahead of things. Still ahead on Power Lunch, the auto parts market is red hot, but will it continue into next year? Our driver's manual segment looks at which names will continue higher. And check out Bitcoin right now, tumbling to lows of the day, really lows of almost the week at this point. If you go back at least to the earlier part after it rebounded from Saturday's big plunge, we're down 5.5%. We're back below 48,000, and we're back in a moment. Welcome back, everybody. 90 minutes left in the trading day. Let's get you fully caught up on the markets. Stocks, bonds, commodities, and what could be the first $3 trillion company in the U.S. We'll begin with Bob Pisani down at the NYSE. Bob, the Dow staging a rally today, the others not so much.
Yeah, it's a defensive rally. The problem is how much farther can you go based on the data we have? Look what happened to the S&P yesterday. We closed within 3 points of an historic high. Tech was at a new high. We were 2% off historic highs on cyclicals like energy stocks and industrials and materials. We've just kind of pushed it as far as you can possibly go. And you can see this in the markets today. Stuff that did really, really well in the last couple of days. Biotech, for example, did well. The semiconductor index, SMH, hit a historic high. That's not doing anything today. Instead, this defensive stuff like consumer staples and healthcare are doing well. And that's why the Dow has rallied in the middle of the day, because it's got a lot of that stuff in it. So take a look. You can see some of the defensive names in the Dow, like Pfizer, Walgreens, for example, McDonald's, Procter & Gamble, Johnson & Johnson. That's what's moving the Dow forward. The S&P a little less weighted towards that, and that's the issue. Meantime, the thematic tech, all the Cathie Wood stuff that's been moving in the last couple of days, look, that's doing nothing right now. Total round trip again for the stuff that's most active. Kelly, back to you.
All right, Bob, thank you very much. Now to the bond market, where yields were dropping for the first time in 3 days till a 30-year auction went over pretty poorly. How is it looking now, Rick?
You know, it's looking about the same as it did before the poor auction, but we did get some selling there. If you look at it early intraday of 30-year, you could clearly see right at 1 Eastern that rates popped up. They moderated a bit. Here we sit right now at 187 yield. That's down a couple of basis points. And yes, Kelly, you're right. 30s, 20s, 10s, 7s, 5s, 3s, 2s. They are all lower in yield for the first time this week. And if you look at a 2-day of 30s, and I brought the 2-day, what's interesting is even though yields are a bit lower in 30s, it's after a nice little sell-off that pushed rates higher yesterday and actually had a steepening day, which has been rare, very rare. Because look at the 2-day of 2s, and you can see what I mean. Contrast that, where the 30-year went up yesterday and sideways today with a little dip lower. The 2-year is a completely different animal, mostly sideways trade, didn't have the big bump yesterday. And 10s minus 2s on the spread. 2-day completely shows the dynamic of steepening yesterday, back to flattening today. How flat is it? It's the flattest in just about 1 year. Kelly, back to you.
Wow. All right, Rick, thank you very much. Now to the energy market. Oil closing for the day, having a big week. Pippa Stevens has more for us. Pippa.
Hey, Kelly. Oil falling today here into the close, snapping a 3-day winning streak and giving back yesterday's gains. Now, this activity is tied closely to what we've learned about the Omicron variant. New restrictions and new information about just how contagious it is stoking some fears around demand. But oil's also rebounded nearly $10 from the lows earlier this month, so also could be some profit taking here. WTI is down 2.25% at $70.73. Brent crude is down about 2.1% right now. Now, JP Morgan noting today that while there is this near-term uncertainty, each new wave has resulted in a smaller impact on mobility, and they see demand hitting a record high next year. And despite today's losses, both WTI and Brent are up more than 7% for the week, on pace to snap a 6-week losing streak with the best week since August. Kelly, back to you.
Thank you very much. Now to Apple, the stock hitting an all-time high today, and it soon could become the first company to hit a $3 trillion valuation. We're really close to those levels already. But does the company have anything up its sleeve that could drive the next leg of growth? Steve Milinovich is now a consultant with Tech Advisor LLC. He joins me now along with Chris Caso, who is a managing director at Raymond James Equity Research. Welcome to you both. Chris, I'll start with you. Nuts and bolts, price target on Apple.
Right. Well, we still think that there's a lot of room to go here. The valuation, although you're talking about the $3 trillion valuation, it's still a reasonable 25 times for what I think is one of the best franchises in tech. And remember, right now is that Apple isn't fulfilling all of demand because of the supply constraints that they and a lot of others are facing. So, we think we're going to exit the year with a lot of unfulfilled demand, which drive some unfulfilled demand spilling into the first quarter and the first half of next year.
And Steve, there's now, Morgan Stanley this week raised its price target to 200, put out a note saying time to price in new products. They're talking about the goggles. They're talking about the car. Is it time for the conversation to move in that direction? Is that the catalyst above $3 trillion?
I think it could be, Kelly, and I think it is time to start thinking about this, since we could see augmented reality glasses possibly in the spring, at least the first iteration. Years before the iPhone, Steve Jobs was asked how he grows the company, and he said, "I wait for the next big thing." Apple's been waiting for the next big thing. They've been riffing on the phone with the watch, with the AirPods, very successful products, 1 billion users now of their products, creating a recurring revenue stream. But everybody's always kind of saying, what's the next big thing? And it appears that the car is probably too far off at this point, but it appears that augmented reality is that next thing. And I think we'll see some of that next year.
Steve, is China in any sense a threat to Apple? In other words, could it be that investors say, hey, you're doing business in a country that has concentration camps fundamentally, or that China somehow tries to get back at the U.S. through Apple?
It's certainly a sensitive topic, increasingly so. Apple, I think, is in a pretty good position. I mean, they're dependent on China. It's about 20% of their business. Half of the sales of iPads and some of their products, they are still to new users, which really stuns me. But my sense is that they have kind of an understanding with the Chinese government. Apple made an investment in Didi years ago, which was kind of strange, but suggests that they'll put billions of dollars in various forms into China, including their supply chain. And China will, for the most part, probably stay off their back. So it's interesting because Tim Cook, of course, is very concerned about ESG and issues like that. And it's got to be difficult for him, given what's going on there. But the fact is he's got shareholders, and I think he's doing the best he can. But I don't think that Apple's at substantial risk in China.
It's an important point, Chris. Talk through the risks that you see there from its supply chain. Even for iPhone sales this holiday season, they seem to be constrained and only, it could be a big number, but maybe not as big as demand really would have you think.
Yeah, and I think that's right. And remember what Tim Cook said on the earnings call is they expected solid year-on-year growth in every category except iPad. I believe what they did was they reduced some of the iPad production purposely because iPhone shares a lot of the same components, is more profitable for them. So certainly they're leaving something on the table with respect to the holidays. But what we saw, and remember last year that because of COVID, some of the higher end iPhones were released late, and that demand persisted into the beginning of this year. So, I think iPhone is just such a important product to people. If you need a phone, you're going to buy a phone. If you can't absolutely get it for Christmas, that's going to come into next year. And then remember, there's also this 5G upgrade cycle that's ongoing. And that's the main reason why we got positive on the stock in the middle of 2019 is for this 5G upgrade cycle. And there's still a lot of room to go on that. The penetration rate and the upgrade rate is still not fully there. And we think that continues into the next year. And then as you go into the fall of 2022, then you'll get a new form factor iPhone and just another reason to upgrade. And then finally, if we do get some sort of a virtual reality or something like that, it just builds the ecosystem, right? Is that if there is a headset that would be paired with your iPhone, and you'd have to have an iPhone, probably a new iPhone in order to use that. So I think it all goes together.
Very quickly, Steve, if you invest in individual securities, is Apple a cornerstone holding, almost a must-own?
I think it probably still is. The stock obviously has outperformed, particularly since mid-November. And there's been a bit of a bear stealth market in tech. I mean, you guys have talked about individual stocks like DocuSign being taken out and shot. And I think that's why investors right now are not so worried about demand or even supply constraints for Apple. It's a safe place to be. But with 1 billion users, their ability to continue to create new products, recurring revenue streams, the multiple's high, but relative to this crazy market, it's not that nuts. I think it should still be a cornerstone of an investment portfolio. Makes it tough for portfolio managers that are active because most of them are going to be underweight Apple.
All right. Steve Milanovic and Chris Queso, thank you very much. Coming up, our continuing driver's manual series, where we look at all the parts of your car and which companies make them and can profit as investments for you. Today, we look at where to buy the parts, best bets among auto parts retailers when Power Lunch returns.
Time to open up our driver's manual. And today we're looking at companies that sell the parts and services needed to build cars and keep them running. Companies like AutoZone, O'Reilly, Advance Auto Parts, and Monroe. Brian Nagel covers this part of the auto industry for Oppenheimer. Brian, it's good to see you again. I want to start with an observation that you make, which is really interesting, that in some ways, people waiting for the EV transition to play out, maybe thinking they might want a Rivian in the future, a Cybertruck, something like that, that's lengthening car ownership right now in a way that might create demand for these services. Is that right?
No, I think that's absolutely true. I mean, look, I take it just a quick step, further step back. You know, I like you said, I follow very closely the space and I have for years. I mean, the demand growth in the aftermarket auto parts business right now is as strong as I've ever seen. And it's this confluence of factors that's helping to fuel this. I mean, one factor in my mind is exactly what you're talking about, this almost like this paralysis on the part of consumers. People are saying, my next car will be an EV. I just don't know which one yet. So as a result of that, they're holding on to their current cars longer.
Right. So let's talk about how the stocks could further benefit, because they have done really well in this landscape that you're describing. You like O'Reilly, you like AutoZone, but not so much Advance Auto Parts. Is that right?
Yeah, look, I recommend my two favorite names right now are AutoZone and O'Reilly. Look, Advance has done some great work, and their business has gotten stronger as well. But I still just don't think they are as quality of an operator as AutoZone and O'Reilly. And so long as the valuations of AutoZone and O'Reilly are still accommodative, I tell our clients, look, it makes more sense in my mind just to play those higher quality names. Between the two of them, actually, I think AutoZone's the best position. They have a much bigger opportunity as they continue to push into the commercial business, which is basically their way of serving the kind of these smaller mechanics.
This is a kind of out of left field and random question. I look at the prices of AutoZone and the price of O'Reilly, and I wonder, in the old days, those stocks would have long since split. Why don't stocks like that at those price points split anymore? Is it because people can buy fractional shares, or their audience is just different from the individual investor who might be a little put off by a $1,400 share price?
Yeah, it's a good question, Tyler. I don't really know the answer. I mean, I would say, again, in my looking at stocks, I definitely see now much higher price names.
Yes.
In fact, just this morning, we lifted our price target on AutoZone to 2,500. So when I was writing my report, it caught me. It's like, here I'm talking about a $2,500 stock. I don't know the answer. I mean, I think to a certain extent, though, these companies are looking at, there is this view, so to say, of these really high price stocks as really high quality names. Now, obviously, we see that in some of the tech areas as well. So maybe that's the fact. But I really don't know why.
Yeah.
They haven't.
I was just curious. I was just curious. I mean, you obviously create more numerical stock. It doesn't change the value of the company at all, but you just create more numbers of shares out there to be bought.
I'm curious as well, Brian, before we let you go, about Monroe, which doesn't quite fit the business model of the other retailers, more of a service model. You're only a hold on that. Why?
Well, look, so Monroe it's a smaller cap, and like you said, they operate service centers. I keep a very close eye on Monroe. There's a new CEO who I've got to know. I think he's doing a nice job there. The business has just lagged. And what I've written to our clients is for a long time now, despite a solid backdrop, we just haven't seen the really strong results out of Monroe. And that tells me there's something wrong. There's something not right in that business model. But like I said, new management team. I'm very interested to see what they can do here. It's one we've got our eyes on.
All right. Brian, thanks for your time today for this edition of Driver's Manual. Brian Nagel.
Thank you.
All righty. Crude oil down slightly today, but still up 7% so far this week. And up next, we look at the big oil stocks. We'll tell you what analysts say and get our traders' opinions. That's next. Welcome back, everybody. Energy stocks leading this year. Yes, you heard me right, but are the worst performers in the past month. JP Morgan betting they can be leaders once again in 2022, calling ExxonMobil, Phillips 66, and Suncor Energy their top picks. Analysts saying favorable commodity prices, healthy balance sheets, capital return plans should drive gains for the group. Let's discuss this with your Trading Nation team. Nancy Tengler of Laffer Tengler Investments, Boris Schlossberg of BK Asset Management. Folks, welcome. Nancy, let you kick it off. What do you think of the big oil names? Is it time?
Well, I think it's been time, and there are ways to play it going forward, to be sure, Tyler. We're overweight the group, which isn't hard because it's very small weighting in the S&P 500. We had been playing the upstream names like FANG. I think if you own FANG, it's too soon to sell, but I don't think you chase it here. We also recently added to Phillips, which is part of the JP Morgan upgrade. And I think that makes sense for a lot of reasons. The company is going through cost restructuring. They seem to be turning the corner on some of the execution problems they had. And we think that the oil boon is going to continue, even though Omicron has impacted the headlines. Every time we get a new wave of the virus, it has less impact on mobility. We've got global daily flights that are about 80% of where they were in March 2020. And we've got a disciplined OPEC and disciplined company management teams. For the U.S. to bring supply back up to levels that we saw pre-pandemic, it's going to take to July of 2023. So I think there's going to continue to be upward pressure on the price of oil. And I think there's still ways for you to make money in this sector.
And Boris, you sort of have a similar thought here, but your preference is to play it through an ETF. Why?
I don't think investors need to overthink this. I think you could simply stay long XLE, which got a beautiful 3.5% yield right now. In fact, one of my favorite strategies is kind of a yield enhancement strategy, which is just be long the XLE and then sell a little bit out of the money calls against it about 180 days out to just really enhance your yield. I did that in the last 6 months. It's worked out beautifully. I think it's going to continue to working out very well, barring COVID turning into some kind of another deadly strain. Unless we have that situation, I think it's pretty much a certainty that the energy market is very imbalanced in terms of supply and demand. I'm not a hyper bull on oil, but I certainly think that at these levels and at these margins, all these majors are going to do very well. I think owning the XLE is a no-brainer at this point going forward.
All right, man. I like no-brainers, man. That sounds good. Nancy, Boris, appreciate it. Thanks. And for more Trading Nation, you can head to our website or follow us on Twitter at Trading Nation, Kel.
Up next, Americans have 3 top priorities for U.S. companies these days. We'll tell you what they are and reveal the results of a Just Capital exclusive survey next.
And now, the latest from tradingnation.cnbc.com and a word from our sponsor.
During bull markets, many traders find themselves attracted to small cap stocks because they have a tendency to have a higher beta, meaning they generally move up faster than the broader market. But don't overdo it on the small caps because they're also more vulnerable to pullbacks. I'm Joanna Payne, and Schwab is the better place for traders.
All right, welcome back, everybody, to Power Lunch. CNBC and Just Capital recently announcing a media partnership that will allow us to bring our viewers the Just 100 rankings. Not just 100, it's the Just 100 rankings this January, as well as other reports throughout the year with detailed metrics about how Fortune 500 companies treat their stakeholders, from their push on inclusion to ESG initiatives to the communities they serve. And today, the firm releases its survey on the top issues that stakeholders want America's corporations to prioritize. Joining us now with the exclusive results of that survey is Just Capital's CEO, Martin Whitaker. Mr. Whitaker, welcome. Good to have you with us. Let's go through these things. You look at, I don't know how many metrics here. You polled people and asked them what was most, maybe it's 15 metrics. And the thing that was number one was pays a fair living wage. That's what people want out of these big companies.
Thanks, Tyler. Yeah, that's exactly right. It's actually 20 issues. Those issues themselves come from years of surveying the American people on a fully representative basis. We've been doing this a long time now. Those are the things that rise to the top. And when we ask them to weight those issues, which we do every year, this has been at the top or close to the top of the list really from the beginning. You know, a just company, in the eyes of the American people, pays its workers a fair and livable wage. And I think that sort of taps into, you know, a fear and a concern that many working Americans have about being able to make ends meet. And I know we've spent a lot of time on that subject of what is a fair wage, what is a livable wage, and why is it good for business to provide those things.
Yeah, I think what I like to do when I see surveys like this is look at changes and percent changes. And while this pays a fair living wage has been at the top or among the top three in 2021, it gained 6 percentage points from last year. Item number two is creates jobs in the U.S. And this issue rose to number 2 in relative importance, up 8 slots from 2020. Why?
Well, I think what you've seen with COVID, the economic shutdown and reopening, is just a huge amount of uncertainty in employment. And you see that now with the number of jobs that are open, about 11 million jobs, I think, in the last report, the number of people quitting jobs. I think there's a massive turnover happening, and people are feeling generally insecure about that. So when you ask folks, what does a just company do? And creating good jobs, especially, I might add, in communities that need them the most, you get this quite astounding agreement among a lot of Americans that that is something that a company today, you know, really must prioritize. And companies that do that, you know, are going to be, you know, better employers, but able to attract and retain talent.
Martin, I was also noting that creating jobs in the U.S. seems to be rising in importance. Talk about that.
Well, I think people are fearful of losing their jobs. They're fearful of job security. Obviously, you know, they're worried about companies exporting jobs or, you know, moving jobs overseas. And I think people are really concerned about being able to provide for their families and be able to provide for their futures.
Yeah.
So it doesn't surprise me that jobs, and I think when you look overall about employment overall, I think the relationship between American companies and their workers is the story here. That's what's changing. You know, you got the gig economy. People are fearful of what, you know, automation means for their jobs. So I think there's a general level of anxiety about the future of a good job and what that means in America today.
Prioritizes accountability to all stakeholders. This more than doubled in priority among the survey respondents and went into number 3 position from number 11. This basically means don't just serve the shareholders, but serve the community, serve the workers, serve the employees, and so forth. Let me ask you how you use these metrics in determining that just 100. Do you then go and use these metrics and match companies against them somehow?
That's exactly what we do. So we track companies. Russell 1000 is our universe.
Right.
We track them objectively. We get the best available data, and we measure what are they actually doing, you know, on these criteria, all these things that relate to 5 stakeholders. And the
Right.
5 stakeholders are workers, customers, communities, shareholders, and the environment. So the Just 100, which you mentioned at the top of the piece, is exactly that. It's a list of the top 100 companies that do best across all
Right.
sectors on those 5 stakeholders.
Well, they're playing our music, Martin. We got to go, but thank you so much, and we look forward to the Just 100, which we will see sometime early next month.
Thanks for watching Power Lunch, everybody.
Closing bell starts right now.
Hello and welcome to Closing Bell. I'm Sarah Eisen here at the New York Stock Exchange. Mixed session here on Wall Street after 3 straight days of gains. The Dow's still in the green, but the Nasdaq under increasing pressure here as we head into the final hour of trade.
And I'm David Faber in for Wilfred Frost. Let's give you a look at what is driving the action at this hour. Tech, well, it is slipping today. Chip stocks are pulling back again. Tesla, Peloton, Zoom also weighing on the NASDAQ 100. We did get some positive news on the data front ahead of tomorrow's key CPI reading. Weekless jobless claims coming in at 184,000. That was the lowest level in 5 decades. And crypto, it's having a rough session as the volatility in that space continues. Bitcoin trading back below $50,000. We've got 59 minutes left to go in today's session.
Wow, Peloton down 12%, Tesla down 5%. Coming up on today's show, 3 lawmakers at the forefront of global tech regulation. We'll talk in a first on CNBC interview to Senators Marsha Blackburn and Senator Richard Blumenthal, who led this week's hearing with the head of Instagram about protecting kids online. Plus, you will hear from European Competition Commissioner Margaret Vestager following news today of a big fine from Italy against Amazon.
Let's focus on the big stories that we are watching at this hour. Mike Santoli is tracking all the market action, and Sarah has more on that Amazon fine. Mike, though, let's start with you, of course, and what you are focusing on for this last hour of trading.
Yeah, David, market kind of regrouping after going up 3.5% or so in 3 days to start the week. Obviously, a powerful rebound. It looks like that low that we reached last Friday, can probably be considered the low for a while unless something radical changes. But what's the headroom here above the market? That remains a question. So again, nothing surprising about taking a pause, but where it did take a pause, just a 1 point above 47.01. There have been 5 closes above 4,700, not one of them as high as 47.05. So it's starting to give the look of a barrier, at least until proven otherwise for the market. I'm kind of wondering if it might end up looking a little bit like this box here. This was another kind of pretty powerful pullback that we got here February into March. And then, you kind of make a new high rollover test, but never did go back to that initial pullback low. So we'll see. That's just one thought. Also, we are having stalled out here. It's also the plus 25% year-to-date gain level. I don't think there's any particular magic or significance to that, but it's worth noting. Maybe it's a mental accounting thing for the markets. Now, S&P 500 is vastly outperforming everything else in the market. That includes small caps and includes a lot of big stocks that are not in the S&P. I like to look at the extended market index to show. So you did get a real strong bounce in the rest of the market as the S&P did, but it's sort of rolling a little bit. That's a lot of those kind of broken growth stocks, as well, of course, as small caps, which are underperforming once again today. In terms of the NASDAQ, it's getting really concentrated again. NASDAQ 100, which itself is very top heavy with those top 5 holdings, this is NASDAQ 100 relative to the composite. So the composite's over 3,000 stocks. The NASDAQ 100, of course, is 100. And you remember back here at the depths of the market in March of 2020, naturally the larger stocks held up a little bit better. And then we had that real peak of FANG mania, pandemic stocks and nothing else. That was September 1st of last year. We're above that right now. So I think an optimistic way to say is there's a lot of catch-up potential for the rest of the market. But the tough part is where all the market cap sits is getting a little bit top-heavy once again, guys.
Mike, keeping an eye as well on shares of Apple. I know we all follow it closely. Not quite at $3 trillion, but up again today. What I've noted, and I'm sure you have, is the incredible outperformance of that stock over the last month versus the S&P. It's really been staggering.
It is amazing, David. Of course, it's up more than 8% month to date, right? I mean, we're only 9 days into the month, and it does go on these streaks. The Apple kind of goes its own way, and so at times it seems to be lagging for long periods, which it did from September 1st of last year way into the middle part of this year, and now it seems to be kind of doing more work than the rest of the big stocks out there. I don't know if the $3 trillion mark is sort of sitting out there. It resembles to some degree the action in the stock last December, which I looked at. I think it was up 15% November 30th of last year till right after Christmas. So who knows if it's something seasonal, but there's definitely a lot a fevered interest in it if you look at some of the heavy volumes in the Apple options as well.
Mike, thank you. We'll see you soon. Mike Santoli. Amazon under fire. Italy finding the tech giant today $1.3 billion, saying Amazon is harming competitors by favoring sellers on its platform that use Amazon's own logistics service. Meanwhile, Amazon also faces another investigation by the European Commission over anti-competitive behavior. I did speak exclusively today with Margaret Vestager, EU Commissioner for Competition, and asked her how the EU is working with the Italian regulators on this case.
Of course, we've been comparing notes with the Italian competition authorities. They have a very specific case for the Italian market. And when we opened one of our Amazon cases, of course, we made a carve out in order for them to continue what they were already doing.
So they didn't steal your thunder here.
Well, you know, it's not about stealing thunder. It's about making sure that the market is open and contestable. And I think a case like this one contributes exactly to this purpose.
Amazon, no surprise to you, I'm sure, is going to appeal the case. They say it's unfair. They say it's a disproportionate fine. And they also say in the statement, I just want to read you a part of it because it resonated. Large companies are not dominant just because they are large. And the presumption that success can only be the result of anti-competitive behavior is simply wrong. How do you respond to that?
I think it's unrelated to the case and the assessment of the Italian authorities. Of course, it is a valid point that being successful doesn't mean you've done something wrong. And being big is not a symptom that you will be doing something wrong. So I think it's important to have these discussions. But when it comes, for instance, to retail, there is a difference between brick and mortar retail and online marketplaces. I think everyone can see that also intuitively, and that, of course, is part of the foundation also for the cases of the European Commission.
So do you think Amazon is acting anti-competitively by giving unfair treatment to its third-party sellers that use its own services, its shipping services? Do you agree with that?
Well, we are looking into a similar issue, but we have no conclusions yet, so that I don't know. We're also looking into the issue of Amazon, enabling the data from the small merchants of the Amazon marketplace to be available for Amazon retail. And by doing that, giving them a huge competitive advantage. So we have a data case just as well as a case about how to get into the buy box. Does that depend on whether you use Amazon fulfillment or not?
We will have much more from that interview next hour, including Vestager's thoughts on Google, on these new Apple charges she's bringing, and regulating M&A in Europe, which she's increasingly doing and getting more aggressive in doing. No surprise to you there. On this case in particular, so what the Italian authorities are alleging is that Amazon, through its dominant market position, gets the Italian sellers, encourages them to use the Amazon fulfillments, and then the Italian sellers that use other fulfillments, the competitors, get left out of Cyber Monday sales and promotions and that sort of thing. So it was specific, but the EU is looking into it as well. And I think, David, what it shows is that Europe is much more active when it comes to regulating and fining these big tech companies.
They have been said to be ahead of us for quite some time when it comes to dealing with these enormous platforms. So glad I was here for a Vestager interview day.
I know.
I mean, I kind of missed them.
Right. So
Yeah,
here you go.
yeah.
And we've got more in the next hour.
I can't wait. I can't
Google,
wait.
Apple, and much more. And we've got two tech lawmakers here, or lawmakers that are trying to regulate tech.
Yes,
Blumenthal and
Blackburn. An unlikely couple, those two. But you'll see them
very
together.
Much in agreement here.
Yes, on
over
agreement
Instagram.
when it comes to social media, and you will see them shortly as well. But speaking of what's coming up after the break, the retail sector is pulling back a bit today. Still having a very solid week. We're going to ask the CEO of Abercrombie about what she is seeing from customers, both in stores and online. You're watching The Closing Bell on CNBC. Welcome back. Let's give you a quick check on GameStop, the original meme. It is near session lows this following last night's earnings release. As you see, down over 12% shares of GME. Sarah.
Now up only 1,000% over the last 12 months.
Yeah,
or so.
that's right. Exactly.
Sticking with retail, all week we've been taking a closer look at the consumer with retail leaders. And today we're diving into Abercrombie & Fitch. Shares are up big on the year, but falling more than 20% since reporting Q3 earnings last month. Despite beating expectations, and both investors have been focused on the supply chain challenges that the company faces and the potential impact on Q4 and beyond. Joining us now for an exclusive interview is Abercrombie & Fitch's CEO, Fran Horowitz. Fran, welcome back. Good to see you.
Good to see you too, Sarah. Thanks for having me.
So how is the holiday season going for you, and what's different about it this year when it comes to supply, merchandise, and what you're seeing from consumers?
Sure. So as you know, we reported before the Black Friday weekend. At that point, we were excited about our third quarter results. We're seeing a healthy, strong consumer, particularly in the United States. Our third quarter performance in the U.S. was up 17%. We were pleased to see the start of the fourth quarter as well. Our brands, honestly, Sarah, they are firing on all cylinders. Our product voice experience is really resonating with the consumer.
You really have turned this business around, Fran. In the last quarter, sales highest since 2014. Why do you think the market didn't give you credit for that and has been selling off since?
You know what? Thank you for noting that. We're super excited about the performance. In fact, on top of that, we had our best Q3 op margin and profit in nearly a decade. I'm going to let the market analyst comment on the stock price. I'm focused here on the business, the long term. I'm sure you saw that our board just approved a $500 million buyback. That shows the confidence in the board with the business. So lots of exciting things, but really focused on the long term.
When you held your conference call a few weeks back when you reported those earnings, you said the delays in the supply chain will allow you or expect you to deliver newness leading up to the holiday peak. So are shoppers seeing newness in the stores right now? And, how is it going in terms of dealing with that supply chain?
Awesome question, David. Yes. So it's, usually we have most of our goods here by Black Friday. Now we're actually able to surprise and delight the consumer all the way up to peak because we are receiving goods on a weekly basis. So they continue to come back. We market to that point so that they know that we have newness both online and in the stores. And it's exciting to have a new flow to product, and we'll learn a lot this year from having that happen.
Are the production delays getting better or worse or the same?
As far as the production goes, all of our factories are open, up and running. There's obviously still some delays getting the product here for our consumer, but we have been navigating that all year. You can see the results we put up, first, second, third quarter, and we still had those challenges out there. Hats off to my team that's been able to navigate all of it and get the product here successfully for our customer.
Fran, you just said you'd learn a lot from, having the newness sort of this late in the season. What is it you'll be focusing on to try to learn so that, perhaps next year you'll be able to put some things to work as well?
Well, I think that's the opportunity, David. I think the opportunity to flow goods on a weekly basis and not have it all, here prior to Black Friday will help us flow the whole quarter differently and continue to surprise and delight our consumer by having newness for them as they continue to come back and shop. So those customers that shopped early, they'll come back and they'll see some newness and there'll be a reason for them to shop again.
New jeans. Everybody wants new jeans right now.
Yes,
right, Fran?
Yes,
Why?
they do.
What's going on with
jeans? Because the silhouettes have totally changed.
The silhouettes?
It's the styles.
Oh.
How long is this going to last? No, so people are throwing out their skinny jeans. They're buying wide leg, flare.
You're spot on, Sarah. Yes, actually, a couple of things are happening. So we're seeing across brands and genders a lot of newness happening in denim. And, the skinny jean is still here, and it's part of her assortment, but she does have a reason to buy newness, and that's the wider legs, the higher rises, the lighter washes. So everybody needs a new pair of jeans, and across men's, we're seeing the same thing. Our straight jeans are selling. It's exciting to see newness across both genders.
I'm curious, Fran, about marketing, because you've made some changes there as well, and you've invested a lot. And I'm wondering how much TikTok and Instagram are part of your marketing budgets right now and dictate what is cool and what is fashionable and what teens especially are buying, and gaming too, which I know you're focused on.
Yes, so super, super exciting. So I have to tell you, we have industry-leading marketing teams here, and they're doing a lot of incredibly innovative things. One particular thing, to your point, is TikTok. We had a TikTok takeover, during the week of Black Friday, where 75% of the consumers from 15 to 54 saw our brands all week, which is very exciting. The consumer is seeing things on TikTok and responding faster than ever, so their whole ability to adapt to newness is happening a lot faster. You also mentioned gaming. So in our Gen Z consumer for Hollister, 90% of the kids today consider themselves gamers. So we partnered with Booga, who is the world champion for Fortnite, and did some product with him. And he's our chief gaming scout. And he's helping us bring gaming into that community, bringing product into that community.
Got it. Thank you for joining us. Good to get a check-in with you.
Thanks. Have a happy holiday.
You too.
Bye.
Well, coming up next, how Americans really feel about the economy, how they really feel. We're going to bring you the results from our latest CNBC All-America Economic Survey, including the surprising number of people who think it's not a good time to invest in stocks. As we head to a break, check out some of today's top search tickers on CNBC.com. Tesla makes the list today, as we've noted earlier, down over 5%. That is weighing on the NASDAQ. We're back right after this.
Welcome back. NASDAQ under pressure here with 37 minutes left of trading. The pain being felt in names like Tesla, some of the winners lately, NVIDIA, Microsoft, Amazon, all under pressure today. You do have that balance with some strength in names like Cisco, Regeneron, but it looks like most of the tech names are under pressure. And if you look at the overall S&P 500 and the sectors there, technology is underperforming. Only healthcare, staples, and utilities are higher. consumer discretionary, the worst performing index right now, or sector, down 1.4%, and Tesla's a big part of that story.
Yeah, Tesla and some of the other high flyers as well in that sector. Lucid down over 17% after a $1.75 billion convertible notes offering was announced late yesterday. All right, let's get to the results of our latest CNBC All-America Economics Survey with some surprising findings about how Americans view the economy and the climate for investing. Steve Leisman has all those details for us. Steve.
David, yeah, Americans head into the holiday season downbeat on the economy, but upbeat on spending. 41% of Americans believe the economy will get worse in the next year. It's a modest improvement from last quarter, but still far from normal levels of around 30% and down from a year ago. The number is driven by highly partisan split, with 67% of Republicans pessimistic compared to just 16% of Democrats. Now, those negative views come as inflation has rocketed to the top of the list of concerns among the public. The survey of 800 Americans nationwide finding 43% saying higher prices is one of their biggest concerns. That compares to 38% who say it's the coronavirus. And views on the stock market remain pessimistic at just 33% saying it's a good time to invest. Well, despite those negative economic views, Americans plan to spend 13% more this year on holiday gifts, or the most in 3 years, topping $1,000, with some saying they'll spend more because of higher earnings and others because of higher prices. So the survey showed strong expectations for wage growth. So it may be that when it comes to spending for the holidays, an optimistic earnings outlook beats out pessimistic economic views. And Sarah, it took me 10 years, I'm straight legs now. And now you got to tell me I got to change?
I know. I didn't even know what a silhouette was, Steve,
Come on,
until it was explained to me.
Everything changed after COVID, especially jean style. You got to go wide leg, tapered, or flared.
I didn't get the memo.
There you go, Steve.
I learn every time I come on Closing Bell, or I'm just with Sarah in general, Steve. I learn things.
You know, you can watch Closing Bell more regularly, or talk to your 16-year-old daughter.
Yes,
I'm sure she knows all about it.
She would teach me a great deal about fashion. All right, let's get back to the stock market, though. You know, I did know that's a fairly negative view that investors have, Steve, from the survey.
Yeah.
I guess 33%. But how does that compare? Are they always negative?
No, not always. Actually, an average number we have is 40% are positive. What's more interesting is that we also break out those who have portfolios of $50,000 or more. They're almost always net positive on the market. They're not now. They've come down a lot. Just 40% of those compared to, say, an average of 55% of those with big portfolios. They're pessimistic now. So that's probably one of the most interesting developments we found.
Steve, thank you. Just looking at the NASDAQ hitting session lows, down 1.7%. We've got just over half an hour left of trade. Dow has also gone negative and is looking at session lows. We're down about 12 points on the Dow. Keep an eye on it. But big sell-off, especially in technology now for the NASDAQ. S&P down about 0.7%, thanks to some strength in some of the more defensive groups today, like healthcare and consumer staples. Still to come on the show, earnings on deck from the likes of Broadcom, Oracle, Costco, Lululemon, and Chewy. All the stocks are down today. We'll bring you the numbers as soon as they hit. Plus, we've got an exclusive interview coming with the CEO of Chewy ahead of his conference call with analysts. And as we had to break, a check for you on bonds. Rally day today, kind of a mixed bag across the curve, but rallying on the 10-year with the yield going below 1.5% again, 1.48%. Closing Bell will be right back. session lows for the Nasdaq as the tech sell-off picks up steam. Time now for a CNBC News update with Rahel Solomon. Rahel.
Hey, Sarah, and here's what's happening at this hour. Dante Wright's girlfriend describing what happened after Wright was shot by former police officer Kim Potter. Elena Payton says that Wright was, quote, just gasping as she tried to help him. Potter says that she intended to use her taser on Wright, but accidentally fired her handgun instead. A Michigan school district has been hit with two $100 million lawsuits. The suits are being brought by the parents of two Oxford High School students, one of whom was shot in the mass shooting that left 4 students dead and 7 injured there. And in Texas, a jury has awarded a $301 billion settlement against Sabar. The largely symbolic award comes in a suit that was brought by the family of 2 people who were killed in a crash with a drunk driver. The suit alleges that the bar served the driver a dangerous amount of alcohol before that crash. And on a lighter note, in Kansas, police and animal control officers had their hands full after a camel escaped a nativity display. By the time the camel was caught, it had taken a stroll down a highway and visited a golf course. David, the police department, they're saying apparently camels are very fast. They can run up to 40 miles per hour. You know.
Yeah, they're not the most friendly either, from what I recall. My time with camels, which was relatively brief. They like to spit on you. Thank you, Rahel. Today marks the moment of truth for Starbucks workers' unionization efforts. Kate Rogers has the latest on an important vote count. Kate.
Hey, David, and that vote count just wrapping up. Workers at one Starbucks location notching a big win today and forming the first union at a company-operated Starbucks store in the U.S. since the company went public. Now, 3 individual stores voted today, with the union and Starbucks each prevailing in one location, one store count unresolved. The Elmwood store, 19 in favor of unionizing versus 8 against. Camp Road, a win for Starbucks with 8 in favor of unionizing and 12 against, although the union claimed that some of the ballots there were missing. And then Genesee Road, the matter is unsettled, 15 yes, 9 against the union, 7 unresolved challenges. So unfortunately, we will not get a result on this store today. The count taking place via Zoom. These results still need to be certified. Both sides were able to challenge during the tallies. The pro-union workers at Starbucks Workers United told me this morning they were nervous but confident, said that today felt like Christmas Eve, and they did score that important first win for a unionized location on their side in the U.S. Starbucks stock, though, only down less than 0.5% today, so investors may be watching, but the stock not really moving on the news, guys. Back over to you.
Kate, thank you. Kate Rogers. Well, Meta, as it's now called, striking a nerve with Washington lawmakers yesterday during a hearing about the company's impact on kids.
Today, I am just a little bit frustrated. I'm frustrated because this is now the 4th time in the past 2 years that we have spoken with someone from Meta, as you are now calling yourselves. And I feel like the conversation continues to repeat itself ad nauseum.
After the break, the leaders of that hearing, Senator Marsha Blackburn and Senator Richard Blumenthal, will join us to discuss the testimony and what comes next.
Head of Instagram, Adam Mosseri, testifying in front of the Senate Commerce Subcommittee yesterday on the impact of the app on young people. One exchange making headlines. Subcommittee Chair Senator Richard Blumenthal asking Mosseri about the company's plan for an app for kids. Listen.
Will you commit to make the pause on Instagram Kids permanent? In other words, stop developing a site for an app for children under 13.
What I can commit to today is that no child between the ages of 10 and 12, should we ever manage to build Instagram for 10 to 12-year-olds, will have access to that without their explicit parental consent.
Not exactly answering that. Let's bring in Senator Richard Blumenthal and Senator Marsha Blackburn, who led yesterday's hearing. Senators, thank you so much for joining us. I'll go to you, Senator Blumenthal, on that answer. I assume it wasn't satisfactory to you. So what can you do about it?
First of all, I think you were very polite in the way you characterized it, not exactly a complete or clear answer. What can we do about it? We can't put thumb screws on him, but we can make known to the world that Instagram is continuing to market and drive content to kids, destructive and toxic and addictive content, and therefore we can no longer rely on them to self-police. They have absolutely betrayed whatever trust they had, and we need now government intervention to make those algorithms that drive that content transparent. They're the black box, 800-pound gorillas that are used to, in effect, hook kids because they're so addictive. And those content like eating disorders, bullying, self-harm that almost every parent in this country knows exist out there, and they've really broken lives. We need to now do something. And I think very, very importantly, what we can do, Senator Blackburn and I, she's been really a tremendous partner in this effort, is develop legislation that can have strong bipartisan support.
Yeah, Senator Blackburn wanted to ask you about that and whether you find yourself in an odd position as a conservative Republican pushing for a heavier hand from government in this industry and what that looks like.
This is an issue that I've been working on for the last decade. Indeed, the first online privacy bill that I brought forward was about 12 years. It was in 2012. And continuing to work on the issue of child online safety and privacy, online privacy for consumers, also data security and Section 230 reforms. Those are the areas that we have to touch. We have to improve. We have to put down the guardrails to make certain that industry knows that they can stay from here to here, but they can't go outside of that. And having that clearly defined, one standard, one federal standard, federal preemption, one set of rules for the entire internet ecosystem, one regulator. This is something that people are saying, you know what, we need to see this so that the online space, that universe is going to be safe and secure, and people can protect their privacy for children and for online consumers.
Senator Blumenthal, I'm always struck a bit by seeing the two of you together, given I would assume there are not that many areas the two of you agree on, but certainly this is one. And, you described Senator Blackburn as your partner on this. So given that, and given the reflection of bipartisanship at hand here, where are we on the bill? When are you going to have something that you conceivably are going to bring to an amenable Senate, if not a House as well?
The quick answer is very soon, because our partnership really is going to produce a bill, I feel pretty sure. We already have a kind of framework. I outlined it yesterday at the hearing. We need to safeguard privacy, as Senator Blackburn has just said so well. The privacy over this data, reams of it collected from kids by Facebook and Meta and Instagram and Snapchat, TikTok, YouTube. Privacy is very important. So is parental tools and controls so they can protect their kids. And then transparency, the visibility of the algorithms that drive this content so that independent researchers have access to them and can actually stop the destructive content. And then also Section 230 reform. The sites have very extensive broad immunity, near unique in any industry. And the UK has a code protecting children that provides for a duty of care. Maybe we should look at that one too. So I think there are a variety of bills. We can pull them together. And if you saw that hearing yesterday, what was so striking and so remarkable is the unanimity of bipartisan concern and outrage. There is nothing partisan about harming kids, or really about trying to protect kids from this kind of harm.
I wanted to pick up on the algorithm, Senator Blackburn, because that was a big theme, and Senator Blumenthal just mentioned it. A lot of fear about the algorithm and legislation around it and auditing it and being more transparent. What is that? What is the algorithm? Can you define that and explain how you can use legislation to get at that? Because I assume from Facebook's perspective, that is the trade secrets of the company.
Well, many times what you will hear the social media platforms say is that they collect this data and then they feed you more of what you want, because the longer you stay online and the more eyeballs they attract, the richer that data is and the more money they make. Indeed, Mr. Masseri yesterday said they were a big ad company, and it was good to get that admission from him that is what they are. They're an advertising company. And Senator Thune has a bill, which is a bipartisan bill. It is a filter bubble bill, and it deals with the algorithms, because with artificial intelligence, one of the things that you know, as they build this algorithm that is going to push you to a certain topic, which is going to feed you more information on that topic, then that is what you see more of. Now, what we know from parents, teachers, and pediatricians is that sometimes it is this pushing of children into following certain celebrities, absorbing and seeing and hearing certain content that leads to some of this self-harm, the mental health issues that children are experiencing. Indeed, also, this is the type activity that leads children to have pedophiles, predators, drug dealers, traffickers who may be following them. So what we are doing, as Senator Blumenthal said, there are several people on our committee who have written bills that would address different components of this. We're through the process of pulling together, drafting text, and look forward to discussing it with you soon.
Okay, keep us posted. Senator Blumenthal, very quickly, too much pressure on Facebook here. Why not look into these issues as it relates to TikTok, Snap? They also have similar demographics.
Great question. In fact, Instagram's greatest fear is it's losing its users to those sites, because maybe they're doing more to heighten the interest or the eyes that are glued to their sites. So you're absolutely right. We need to look at social media as a whole. And in fact, Snapchat, TikTok, YouTube were witnesses in the hearing we held just before this one. This one was our fifth. We may have more. The fact finding so far has been extraordinarily revelatory, but we're moving beyond the revelations now to real solutions. We want more than just fist shaking. We want real remedies. And so the remedies will apply industry-wide, social media-wide, because you're absolutely right. These harms, the destructive content of the algorithms, is common to the sites as a whole. One difference, though, I'll just end on this note, is the others committed that they would make them transparent. So far, Instagram has not.
Senator Blumenthal and Senator Blackburn, we appreciate the time.
Absolutely. Thank you.
Thanks.
Thank you. The stock is a little changed, and the market's not worried about any of this.
Very interesting in that way, in the sense of when you hear two senators and the bipartisan nature of this, you'd have to believe that there really may be action that actually gets passed.
They say to Facebook, we keep hearing about progress. We keep hearing about progress. And you guys are not doing anything. The lawmakers haven't done anything either.
Yeah. These things can happen slowly and then suddenly. All right. Straight ahead, CBS pops on its Investor Day, and Jim Cramer gives his top picks for 2022. Those stories and a lot more when we take you inside the Market Zone. Welcome back. Let's give you a look at what's coming up in the second hour of Closing Bell. We're going to get analyst reaction to earnings results from Lululemon and Broadcom. The CEO of Chewy will join us to break down that company's quarter. We'll have more from our interview as well with the EU Competition Commissioner, that about taking on big tech. And we will take a closer look at the inflation picture ahead of tomorrow's CPI report.
Supposed to be a hot one, but first we've got just under 10 minutes to go in the trading day. We are now in the Closing Bell Market Zone. CNBC's CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. And today we've got Hightower Chief Investment Strategist Stephanie Link back as well. Welcome. We'll kick it off with the broader market. Mixed picture here for the major averages. The Dow in the green again, while the S&P and the Nasdaq are still in the red. The Nasdaq lagging the other major averages, down more than 1%. Can't blame Treasury yields because they're lower today. Maybe a little angst ahead of inflation report tomorrow. What's driving this?
That's definitely an overlay. It was a weaker bounce in the big, like the NASDAQ chart never got as close to the old highs. It seems as if the big growth stocks are where there's the most heaviness in terms of, some combination of profit taking and tax loss selling. it is probably still relevant that the S&P stopped at the same place for the 5th time at 4,700. I don't think it changes the story. We used up a lot of that oversold condition in the first 2 days. The Tuesday opening bounce was really powerful. And I think a lot of people look at that on the chart ahead of the CPI number and say, look, who's to say we don't kind of drift lower just to test things out a little bit, right?
Still at 3% on the week,
yeah.
the S&P.
Yeah, although the NASDAQ, again, is down 1.4%. Stephanie, what's caught your attention today, if anything?
Well, it's actually this week, because we always talk about the macro data. It's super important for earnings, rates, the Fed. But this week we learned a lot about the micro, about fundamentals, about what companies are saying and what they're seeing. And I just want to give you a couple of examples. GE increased their aviation sales for 2023 by 11% higher than where the street is at. And believe it or not, the stock is down today, which is silly. American Express, during this week at a conference season, they actually raised the high end of their guidance for 2022 because T&E, travel and entertainment, is actually stronger than expected. And David, we haven't even seen business recovery yet. So I think there's real upside to that name. Marriott is opening 30 luxury hotels next year. That's higher than expected because of demand. And then we had a whole bunch of shareholder-friendly actions in terms of dividend increases and buybacks. Zoetis, CVS, Stanley Black & Decker, they're also making an asset sale, Carrier. So while I think the macro is always important, it's on days like the day after Thanksgiving when stocks get hit really hard, I go back to my notes and say, I want to own all of these names because they're doing really good things. So I think that's really what the theme for me this week was.
Yeah. Okay, well, stay right there, Stephanie. I want to get to our friend Jim Cramer, of course. He held a special event today where Investing Club members were able to ask him about his best ideas for the new year. Here's Jim talking about one of his top picks. It's Disney, and he says he bought more today for his charitable trust.
I think Disney is way overly hated. Some of it's just worries about the pandemic. Some of it is a belief that maybe management isn't as strong as it used to be. I have to tell you that when you have an iconic franchise like Disney and you can buy 50 points below where it's been, I say you start buying some.
Down 15% or so for the year. Jim, by the way, also recommended Wynn and Wells Fargo. I know, Stephanie, you agree with him on those, I believe.
I agree with him on Wells Fargo and Wynn. On Disney, I don't. I just don't think there's a catalyst. And last year, David, the stock re-rated because of Disney Plus and subscriber growth that beat expectations. They're the beneficiary of a stay at home, of course, right? So fast forward this year, they missed on subscribers for Disney Plus Core. They only came in at 4 million versus 10 million, and they're still guiding to the same numbers by fiscal 2024 in terms of sub growth. But they have to spend a lot more money getting there, more than the 8 to 9 billion that they initially gave us guidance on. So I think, by the way, then the core business margins are under pressure because of heavy investments. And so I think it's probably not going down a lot more from here, but I just don't know if there's a catalyst. And by the way, it trades at 38 times earnings, and the sell side has 75% of them have buys on the stock. So I just think you have time on this one.
Let's hit CBS. Been a big winner this year. One of the best performers right now in the SP 500. CEO Karen Lynch hosting her first investor day since taking the job back in February. Bertha Coombs had a chance to speak with her earlier and has the highlights. Bertha.
Sarah, CBS shares rising today as the company boosted its 2021 outlook and raised its dividend and committed to share buybacks for the first time in 4 years. CEO Karen Lynch putting primary care at the center of the company's pharmacy and health insurance strategy. She says COVID vaccines got customers used to engaging with the company digitally and in person. To grow that connection, they're going to add more physicians into the mix, which could involve acquisitions, but not at the expense of buybacks.
We specifically did a share repurchase program and are committed initially to offset dilution. And then, we'll continue to look at alternatives for capital deployment. We're not, we said today we won't do a big acquisition. We'll do something that financially makes sense.
But trying to bring on more physicians is a very competitive situation. There's a competitive situation for labor and for physicians in particular. Guys?
Bertha, thank you. It's also been a tough day for tech, as we said, but a Buffett-backed fintech name, well, it is one of two stocks that is jumping in its debut. That is debut today. In fact, Deirdre Bosa has the details on that IPO. Deirdre.
Well, David, Nubank and HashiCorp, they're the two IPOs up about 16% and 4% respectively in their debuts. a decent but more muted beginning compared to the average 31% first day IPO pop this year, which some could argue means they were more accurately priced. They didn't leave money on the table. But it could also signal a change in the IPO market. Yes, it has been a record year for listings in terms of money raised, more than $160 billion. But it's been disappointing in terms of performance. Big names like Robinhood, Coinbase, Affirm, Didi, all down 20% or more from their peaks. Perhaps those investors that bought these companies at the peak, guys, they're turning more cautious. And we've certainly seen this trend since the beginning of the year of that first day pop sort of lessening and lessening on average.
Deirdre, lessening is putting it nicely. I mean, I think we've got sort of a record number of companies that went public, their stocks trading below the initial price. Now, that includes SPACs, which, to be fair, so many are trading below 10. But it hasn't been a great year other than that first day in which to own these new issues, has it?
No, and we showed you a chart. The day after that first day pop, the average return is actually negative 17%. So it's those people who are buying on that first day, not the institutional investors, but the people, a lot of the times, retail investors that are buying when they can, that are sort of left holding the bag. So that's why we've sort of seen this trend. And it's certainly been happening in the tech space. I think all but one tech listings has fallen into bear territory over the last week or so. Some have, of course, come back.
Yeah, the consumer names as well that popped in the first day. Deirdre, thank you. There's the 2-minute mark. 2 minutes to go in the trading day. Mike, what do you see in the market internals as we head into the close with the Dow up again, but the NASDAQ underperforming?
Yeah, a little bit sloppy under the surface. Yesterday, even though the market was flat most of the day, the internals were strong. You had stronger advanced decline line. Today, it's been to the negative side most of the day. You see that almost 3-to-1 declining to advancing volume on the New York Stock Exchange. So definitely a give back day. We're spilling lower after the big 3.5% gain in the S&P over 3 days. Take a look at one strong area of the market recently, which is the road and rail index within the S&P 500. This is a subset of the transports, and it has been clicking to new highs. It's basically, 4 railroads and a couple of trucking companies, but it's a pretty decent economic bellwether, especially domestically. It strips out airlines and other things from the transport. So that's a net positive. You see the barely down on the day. The volatility index, it's rebuilding a little jumpy. It's a record decline from above 30 to 20 in just 3 trading sessions. Had never happened before. A 10-point drop had never happened before at those levels. So you see a little anxiety rebuilding as we get into that CPI report tomorrow, which might be that known catalyst out there that's keeping people a bit hesitant, David.
Yeah, mostly a lot of red on the screen. And, I do notice, and I should point out, the health insurers, perhaps, the CVS quarter we talked a bit about, but Humana, Anthem, UNH, Cigna, all actually strong today, we should point out. So you hear the applause building here as we get within 20 seconds or so of that closing bell. But as we said, in fact, sort of tech ending the day on a weak note here with the NASDAQ looking to be down as much as 1.7%. We do have the broader market, the S&P down 0.7 as we get into a close here. A negative day after, of course, some very strong sessions of late. So.
Yeah, down day. Still tracking for the best week, though, for the S&P since February. Welcome back, everyone, to Closing Bell. I'm Sarah Eisen, along with David Faber in today for Wilfred Frost and Mike Santoli, as always, CNBC senior markets commentator. Investors are now set for some big tech and retail earnings. We've got instant analysis for you of results from Oracle, Broadcom, Costco, Lululemon, and Chewy as soon as they are released. Plus, the CEO of Chewy will be here to break down his company's numbers before he talks to the analysts on that conference call. First up on the market, Stephanie Ling from Hightower is still with us. And Steph, you mentioned you were looking company specific. The macro data actually pretty good. I'm surprised you did not mention jobless claims with a 1 handle on top of it today. Which makes sense. If labor is so hard to get, if jobs are so hard for companies to get, they should not be firing workers. But we continue to see new post-pandemic lows there. How are you feeling about some of the cyclical positions tied to the economy in light of some of the recent worries around Omicron and the Fed?
Well, the data is coming in a lot better than I expected. So the cyclicals, my portfolio has actually been outperforming the market, especially on days like today when the NASDAQ gets hit really hard. You mentioned initial claims, obviously very impressive. We have a 4.2% unemployment rate, right? And the more impressive number and confusing number is the JOLTS number north of 11 million and the quit rates at all-time highs. So, I mean, there are jobs to be had and people are not getting them. But the good news is at least wages are going higher at about 4.8%. That unit labor cost number, Sarah, 9.6% this week was huge. So this is why the Fed is going to increase the taper. But the data can support a taper, a faster taper, and maybe even higher rates in the meantime. So, if we get higher rates, I'm very well positioned in terms of financials, and they have been hanging in there as of late.
Yeah. They have. We'll stay right there. Stephanie, last hour we did tell you about the results from our CNBC All-America survey. Respondents said inflation has eclipsed the coronavirus as their number one concern. And our next guest agrees as far as the market is concerned. Let's bring in Dan Suzuki, Deputy Chief Investment Officer at Richard Bernstein Advisors. Why is inflation a concern for you, Dan?
Yeah, David, thanks for having me. I think that, Omicron is clearly not the big risk to portfolios today. I think inflation and the bubble in markets are the two big risks. So inflation, on the inflation side, I think, clearly there's some pandemic related transitory components going on. Those are probably going to last longer than people think. But when you step back and look at the long-term drivers, I mean, Stephanie, mentioned, unit labor costs, rising. That tends to lead CPI. And then if you look at the components, the big component of shelter, that's going to continue to put upward pressure for the foreseeable future. But I think the bottom line is if you step back, the economy is much, much tighter than it was way before anybody had ever heard of COVID. And those pressures are going to continue as the economy continues to grow.
And I know you've also, along with Richard as well, been talking about a bubble. What is it about this market that is giving you sort of concern that we may be, at least in some sectors, in a bubble?
Yeah, well, it's not just that the market's expensive. I mean, the market's been expensive for a while. I think the difference between a speculative market and a bubble is that a bubble pervades society. I mean, that's clear, everywhere you look, in every sector, in every conversation, people are talking about markets and what to invest in. And those are clear signs of the bubble, the use of leverage, the trading volume. So, all the criteria that we have for a bubble have been met with flying colors. And so I think that's the biggest concern that people need to be positioning for. It's not just a risk, but because it creates this huge misallocation of capital, creates huge capital scarcities. And I think those are also the opportunities.
Mike, we are expecting this inflation number tomorrow. CPI is out, and the economist forecast is 6.8%. Yeah. So very high, very hot, even more than last time, the highest since the early 80s. Which gets everyone concerned. But it's been one string of hot inflation after another, and the S&P is up, 20-something percent? 25% this year. So what is the market relationship with these numbers? Because it did feel like a little bit of a sell-off on anxiety about that number tomorrow.
First of all, tomorrow's going to be a little bit of a Rorschach test because the annual number is projected higher, but the month over month is going to be lower probably than we got last time. I mean, that's the forecast because of what you're going up against a year ago.
6.8% would get the headlines.
That's exactly what it is. So it's the psychology.
Reagan-era inflation.
The president today said, well, the drop in gasoline prices isn't going to be reflected in Friday's CPI number. All of a sudden, every trader says, uh-oh, does he have the number? Is it going to be hotter than we expected? I doubt that's the case. It's just a statement of fact. Gasoline prices have come down this month or the past few weeks. I think the reason is total nominal GDP growth is as strong as anybody's ever seen it in their careers, right? So obviously inflation, but also real GDP growth. Real GDP growth tracking 8 to 9%, according to the Atlanta Fed in the fourth quarter. Maybe we don't get there, but it's a huge number. It's enough with very loose financial conditions and with credit markets in good shape to withstand it. Also, no matter what you look at in the bond market, it says this is an inflationary bulge that should actually recede before too long. And it doesn't seem as if you can just assume it's going to be extrapolated into the future beyond the next several months.
Yeah, it's actually takes us to financials in a way. And Stephanie, I noticed that you disagreed with Jim Cramer rather than agreeing with him on Wells Fargo, which I know you like. And what about the rest of financials, given some of the conditions that Mike was just describing?
Yeah, so on Wells Fargo, I totally agree with Jim on that one. And I've been in it for a long time. This is a restructuring story. It's a cost-cutting story. They have an efficiency ratio, David, of 72%. So costs can only go in one direction, and they have an $8 billion cost-cutting plan. And they're the most rate-sensitive of the big six. So for every 50 basis points of increase in Fed funds, that's 15 percentage points accretive to earnings. For every 50 basis points increase in on the long end, in terms of rates, that's 7% accretive to Wells Fargo's earnings. So they're very tied to higher interest rates. I'm hoping for a steeper curve. Right now, we're getting quite the opposite, and it's a little confusing. I think the Fed intervention is kind of clouding the bond market, but I do like financials. I have a very big position again in Wells, also in Morgan Stanley, American Express. As I mentioned, I added to that the day after Thanksgiving. I think there's a lot of opportunity, and these stocks are still very, very cheap.
What about you, Dan? In a world where you're worried about inflation and speculative parts of the market, air coming out, you use the bubble word, do you want to be in the banks?
Yeah, I do. It is one of our bigger overweights in the portfolio. I think the point that Mike was making a couple seconds ago is critical. The fact that nominal GDP is the strongest we've ever seen. We think that people are going to continue to underestimate that. So what we want to own in the portfolios for the time being is stuff that's still levered to that stronger nominal GDP number. I think financials fall into that camp, and energy also falls into that camp as well.
Mike, I know we'll have a little more time to hear from you as well, but heading into tomorrow when I'm here for Squawk on the Street, nice little plug in the morning, what should we be thinking about given the week that we've had so far?
I think it's the market reaction to CPI, to see if that's really the thing that's been hanging people up a little bit right here. And I don't even know what the takeaway is going to be. It's not like the bond market has been racing ahead and saying, I think it's going to be a kind of a eye of the beholder type number. So that's what we look at there. And, if we could find some traction in the NASDAQ, the Tesla pulled back to the $1,000 mark, which I've talked about constantly. People try to defend. NVIDIA pulled back to 300, 304, something like that. So, you see if the flows on Friday start to come in and try to rescue the NASDAQ.
You trying to do less homework tonight?
Yes. No, this is a good place to do my homework. Exactly. Yeah.
Well,
Right.
you could just watch again.
It's going to be late, by the time I get home.
I know,
yeah.
5 p.m. It's
tough.
You got to sleep.
An old guy like me, I need my nap.
You'll get extra time. Oracle earnings just out. That stock is surging. Julia Borston with the numbers. Julia.
Oracle beating expectations on the top and the bottom line, reporting earnings of $1.21 adjusted. That's 10 cents better than estimates. Revenues also beating estimates, coming in at $10.36 billion versus the $10.21 billion estimated. And the company announcing that they've increased the authorization for share repurchases by $10 billion. The company is saying these strong results are being driven by 22% growth of the infrastructure and applications cloud businesses, which are approaching $11 billion in annual revenue. Also saying that they have 8,500 Fusion ERP customers with revenue growing 35%, going into the various growth across the different business lines. And you see that stock's now up more than 5%. Guys?
Julia, thank you. Julia Borston. Oracle with a nice pop after hours here. It's been pretty much flat in the last few months, but has had a really strong run in the last year or so.
Yeah, and it definitely seems to have given you a chance because it was up around 98 or so late October. Generally, software has been, pulling back relative to semis. And so it seems like got caught up in the wash of that. And, buyback authorization has been a very key part of this story for a while. Just kind of high cash flow, not the fastest growth, but navigating into the right areas of software. The parts of the business that are growing more, that are now getting to scale, are the attractive ones, the sort of cloud areas.
Man, it's actually had a big move this year, Oracle.
Yeah.
It's funny, I had a $250 billion market value. Mr. Ellison's done all right, too. By the way, with his ownership of Tesla, let's not forget, even down today.
I always say he owns more than ARK Investment does of Tesla.
Does he?
Yeah, in absolute dollars.
Yeah, right. Yeah. It's not bad. He's got a lot of islands, too, I think, as well.
He does, in Hawaii.
Yes.
Lanai.
Right.
The main one.
That's the main one. Thank you. Yeah. They both know so much, I just can ask questions.
You know the most.
Yeah.
Nobody knows more.
I've forgotten the most.
Stephanie Link, Dan Suzuki, thank you both for joining us. We appreciate it.
Thank you.
Thanks. Good to see you guys.
We are just getting started. You too. We're just getting started here on the second hour of Closing Bell. Up next, reaction to Lululemon's results. The stock tanked on the initial print. It's now coming back. It's only down 0.5%. It's down more than 5%. We're going to talk to a top analyst about what he wants to hear on the company's conference call, which kicks off in just a few minutes. And then later, EU Competition Commissioner Margaret Vestager, the cop on big tech, responding to criticism that Europe is becoming too protectionist when it comes to antitrust. We're back in just 2 minutes here on Closing Bell. Lululemon earnings just out. The stock is really bouncing off of that initial reaction. Courtney Reagan with the numbers. Courtney.
Hi, Sarah. Yeah, so for the top and bottom line, Lululemon is reporting results that are stronger than expected. For earnings per share, reporting $1.62 adjusted. The street was looking for $1.41. Revenues, $1.45 billion compared to $1.439 billion, so slightly above. When you're looking at the guidance, however, for the full year, revenues in line, EPS, though, a slight miss. You can see shares are bouncing around, to your point, Sarah, now up about 2%. The total comparable sales increased 27%. Just stores increased 32%. So that actually looks to be stronger than what we saw online, or the direct-to-consumer segment. Online sales did make up 40% of total sales. The gross margin did increase 110 basis points to 57.2%. And the CFO notes that while there are several large volume weeks ahead, we still feel well positioned for a strong end to 2021. Of course, we'll get more detail on the call when that begins at 5 p.m. Eastern Time. Back over to you.
Courtney, thank you. Joining us now to break down those numbers is Simeon Siegel from BMO Capital Markets. And Simeon, I think you had a market perform on the stock. You're not that positive on it. Anything from these numbers? Obviously, we haven't even heard the call yet that would sort of give you a pause here to maybe change your opinion.
I mean, listen, to give credit where it's due, the question of Lulu is not, are they going to beat? It's how much are they going to beat by? And to Court's point, at the end of the day, that guidance will likely prove conservative. I mean, that's what they are really good at. So there's no question. Phenomenal brand. I mean, I'm wearing a suit on top. I'm probably wearing Lulu on the bottom. But the question becomes ultimately, what do you value this at? If it's a company that's going to do, call it $6.5 billion, a little lower than that this year, work up next year, and it's a valuation of $55 billion, I think from a stock perspective is very different than our perspective as a product and a company.
Yeah, there's not a lot of retailers who get that kind of multiple to revenues. But that being said, perhaps they deserve it. Why do you think they don't?
Listen, I think we don't have to sell. We have a market perform. So I think it's a good question. But at the end of the day, I think the question is, how do you grow into that? Like, to your point, there's not a lot of retailers with that multiple unless they're small. So a lot of new companies, a lot of newly public companies do have that because they're going to grow into the Lulu or the Nike, that size scale. The question is, how do you take $6 billion? Where do you go from there? And I think what's interesting is they're at this very interesting crossroads with a sales and a margin perspective where the consumer and ubiquity, like they're going to have to push through that initial, we find that in North America, around $3 billion is a certain saturation point. And Lulu not only is among the top revenues, it's also among the top profitability, which sounds like a great thing, which is why it is where it is. But the question is where you go from here. So again, phenomenal product, great company, great brand. The question is what you want to pay for it for a stock perspective.
Who are they taking share from?
It would be crazy, but like it doesn't have to just necessarily be sports. I think, like Sarah, when you and I always talk about this, historically, it's a battle between Lulu and Under Armour and Nike and Adi and Puma. And like, I wonder now if we think about what people are wearing to go back to work, whether they're actually taking share from ongoing casual companies. And that's probably what we're going to see. So I think this notion of whether it's athleisure or athletic or active or whatever we want to call it, that category, that opportunity, the pie is growing. Lulu's obviously a core grower within that category. The question we'll have to see is how big that ultimately becomes.
Call's about to start pretty soon. What are you going to be listening for? What should investors be listening for? Sort of keys to the future.
Yeah, so listen, where the revenues go are important, but what Lulu's doing so impressively was Courtney's flag about the gross margin. So that gross margin is beautiful and it continues to grow. So what we need to find out, right, any color around the quality of sale and where that ultimately can go, where that opportunity can unlock will be really important. Lulu operates at a drastically different margin structure than the rest of the athletic peers by almost double. So the question there, as you think about it, where does that go? Is it sustainable? What's the right level when we think about how big the company becomes, but also what level of profitability it can ultimately achieve? So I think that's something we definitely want to keep a keen focus on.
Okay, we'll do that. Simeon, thanks for your time.
Good to see you.
A lot of people think they still have a ton of growth. They only have 552 stores globally, and they're really diving in on the international front. They're opening new stores. So I get Simeon's point, but that's the bull case is there's still a ton of runway growth there.
To his point, though, it is a $55 billion market
highly
value. Always.
valued.
Yeah.
But unlike an Under Armour, which got sort of a similar valuation at one point, they're continuing to post double-digit comp growth.
They've executed.
Yeah.
All right. Chewy just releasing its latest results. Up next, the company's CEO is going to break down those earnings ahead of his conference call. There he is. And later, we're going to get reaction to Broadcom's earnings and the outlook as well for chip stocks. That's when we're going to be joined by a top semiconductor analyst.
Chewy's results are out. The stock is falling hard. Courtney Reagan with those numbers. Courtney.
Hi, Sarah. Yeah, so for the third quarter, Chewy is reporting a loss of 8 cents per share. The street was looking for a loss of 4 cents per share. That equates to $32 million of a loss for the third quarter. Revenues, though, in line, $2.21 billion. That's up 24% year over year. If you look at the full year revenue guidance, it is in line to slightly light. They're giving a range of $8.9 billion to $8.94 billion. The street was looking for $8.945 billion. Gross margin did expand 90 basis points year over year to 26.4%. They note 20.4 million active customers. That's up 15% year over year, and also a new company high for auto ship customers. They do note that the third quarter profitability reflects the impact of ongoing supply chain disruptions, labor shortages, and higher inflation, which of course are factors that everyone is dealing with. Shares, though, down more than 8.5%. Sarah and David, back over to you.
Courtney, thank you. Courtney Reagan joining us now here. First on CNBC is Chewy CEO Sumit Singh. It's great to have you back on, Sumit. So lots to talk about there. Overall revenues in line, margins a miss, users a miss. So tell us what you're dealing with out there.
Well, as I was here last time, it's good to see you, by the way. As I was mentioning last time when I was here, we're really bullish about Chewy's future. I mean, we're delivering 24% growth this quarter on a year-over-year basis, which is comping a 45% year last year. Our Autoship sales that represents the health of the consumer and the recurring repeat nature of our business, is up 140 basis points year over year, achieving a new company high. And then, share of wallet or net sales per active customer, which again represents customer engagement and in the way that they spend on our platform, is up with a new record company high at nearly $420 or up $56 year over year. So overall, when you look at this, right, the momentum's strong, customers healthy, our strategy is intact, and the cost of revenue is essentially what we're dealing with, just like everybody else has been right now in the industry, dealing with disruptions across the supply chain, which essentially were elevated as we moved out of Q2 into Q3. So overall, we remain steadfast and focused on the long-term strategy, and we're proud to be executing at a 24% growth year-over-year level.
But I just have to zero in on the customer additions, 330K during the quarter, which was a miss, and the overall 20.4 million. There's this lingering concern out there around your stock that it was a pandemic play. You did really well. People adopted pets, and you got a ton of customers during the pandemic with everybody at home and shopping online, and that is tapering off, and you're just not going to see that kind of demand and that kind of growth in users. What do you say to that?
Yeah, we're not really seeing it that way. Let me give you a few data points, right? So if you look at the years 2018 and 19 prior to the pandemic, both those years we added roughly $1.3 billion in growth. And then came the pandemic and we added $2.2 billion of growth. And then this year, post-pandemic, when you look at our guidance, we would add somewhere about $1.8 billion of growth. So if you take the pandemic out, right, we've accelerated the growth that we were delivering 2018-19 timeframe by roughly 30% or more. The industry certainly isn't growing at 30% or more, so we continue to gain share is one implication of that statement. As far as the gross adds is concerned, it's simply a math equation. And what you're seeing here is that we're overlapping or lapping a really large set of cohort that we acquired last year. And so our gross adds remain higher than our pre-pandemic levels, and our churn rates remain completely stable. So it's just a matter of mathematics that as we play through this year, those gross adds number, even though all other inputs seem in line, the interpretation of that is that something must be wrong. But in fact, nothing is wrong. Customer engagement's healthy, additions are healthy, and overall top line's great.
What about net spending per active customer? What are you seeing there, and what are your expectations? What will you share on the conference call coming up?
Yeah, so net sales per active customer was up 15% year over year, actually 15.6% year over year, or $56. It's the highest increase that we've seen. I already mentioned that Autoship was up roughly 140 basis points. Our average order values are up 6% and 13% relative to 2020 and 2019. Everything, David, basically in the way that we measure customer engagement, stickiness, loyalty, repeat purchase rate, AOV, and subscription to Autoship, all of these metrics that indicate the health of the consumer and their engagement towards our brand is pretty strong. And as a result, I continue to come back to the fact that we're executing to the long-term strategy, and we're bullish on Chewy's future.
You do mention in the release the supply chain disruption, labor shortages, and higher inflation. As you noted, everybody's dealing with it. It's impacting profitability. Do you have any visibility on these items, how long they're going to last and weigh on results?
Yeah, so I think first of all, it's important to break down a few components because supply chains got worse in Q3 coming out of Q2. And that, I believe that actually caught the industry by surprise. Because, I've been here before and I've talked to you and I've said, look, we were expecting vet food shortage capacities to be actually alleviating in Q3 or the back half of the year. And we've essentially not seen that. The other thing that we saw this quarter that we haven't seen in previous quarters is the port congestion and the imports that got massively congested and escalated, as a result of which the flow of inbound material got disrupted. And then, of course, labor, we were all expecting labor fill rates to be better, coming into the back half of the year. And we have not seen material improvement in labor. So all in all, what I would estimate is that, the port congestions are starting to alleviate. So that I would put to be a near-term, constraint. And then labor and material is anybody's guess at this point. And we're essentially reacting to something like that in real time. We're obviously working very closely with our suppliers and partners to be able to manage that effectively. But it's hard to give a prognosis right now.
Finally, just wanted to ask you about a new business line, the pet insurance, which you announced you're getting into this week. What do investors need to know about how big that business can be and why strategically you're going in there?
Yeah, that's a really fun question. It's a really, innovation is really fun, and that's what drives kind of long-term sustainable growth. At least that's the way we think about it. So us entering the insurance vertical, when you look at pet insurance, we believe that it's a very meaningful and valuable contribution that we can provide to that space. Roughly in the United States, insurance is 2 to 3% penetrated, against when you compare it to countries like UK, where the penetration is 25%. So overall, we believe this is a really big opportunity for us to help expand the TAM for insurance in the United States, and at the same time increase affordability and accessibility of products like these to pet parents that ultimately, elevate the quality of care that we can provide to our pets. And ultimately, we're also looking at this as accretive to the profit line, and stickier and creating stickier, more engaged customers in the way that they interact with our platform and our brand. So overall, we're fairly excited about it, as well as our partnership with Trupanion, who we've used to get to market.
Sumit, appreciate it. Thank you for your time.
Thank you. Really appreciate it.
We've also got Broadcom earnings out right now. Let's get to Josh Lipton, who has the numbers for us. Josh.
That's right. Broadcom reporting Q4 results here. EPS comes in at $7.81. That's versus expectations of $7.74, and revenue up 15% to $7.41 billion. That's versus expectations of $7.36 billion. The Q1 forecast, they're looking for revenue of about $7.6 billion. That's versus expectations of $7.25 billion. Semiconductor Solutions, $5.63 billion in the quarter. Infrastructure Software, $1.77 billion. Also, a new share repurchase program authorized for repurchase of up to $10 billion of common stock. Conference call kicks off at 5 p.m. Eastern. Back to you all.
All right, Josh, thank you. Josh Lipton. Costco earnings are also out. Man, Courtney Reagan has been busy. Courtney, it's amazing. Double-digit U.S. sales growth here.
I know, it is pretty amazing. Costco has been pretty steady for quite some time, particularly through this pandemic, David. For earnings per share, they're reporting $2.98. We are not comparing that to analyst estimates at this point. Revenues, though, are coming in above expectations. And remember, they still give us monthly updates. So this is a good surprise here for investors. $50.36 billion. We were looking for $49.597 billion. As you mentioned, those comparable sales for the quarter up 15%, excluding the impact of gas and foreign exchange. E-commerce up 14.3%. Remember, they've been a bit behind when it comes to e-commerce, so they are still looking to grow that business. The breakdown for the total revenue, $49.4 billion in sales, and then $946 million in membership fees. You can see shares are about 1% higher on these results. Costco shares typically don't move too much in either direction, positive or negative, on the back of most of these earnings reports. But the color on the call can sometimes be pretty fun with some of the items that they've sold during the quarter. So we'll look forward to that. David and Sarah, back over to you.
Courtney, thank you. I could have predicted this. All you have to do is go to a Costco, and like it's the end of the world. I went to the Red Hook Brooklyn Costco. I know New York is a bubble, so it's not necessarily indicative, but
Yes.
like a million people in that store
Really?
buying everything in large quantities. Yes,
Why?
because it's good value to buy big quantities, right? And you can stock up, and they have really useful, good brands.
Nobody has anywhere to put it in New York.
Well, New York City,
Yeah.
yes. But the restaurants go there, and people just do. I don't know. We have boxes everywhere in our apartment of little goldfish packages and all sorts of stuff.
I like those.
Anyway, 17%
Will you
sales
pick
growth.
me up next time?
Let's go. Yeah,
Like
we'll
100 pack?
along for the ride. It is fun. Up next, EU Competition Commissioner Margaret Vestager on why Europe is ahead of the U.S. when it comes down to cracking down on big tech companies. Plus, investors preparing for another key read on inflation, how the latest consumer price index could impact tomorrow's trading day. All of that coming up on Closing Bell.
Time for a CNBC's news update with Shepard Smith. Shep.
Hello, David Faber from the news on CNBC. Here's what's happening now. Trying to prevent a Russian invasion. President Biden and Ukraine's President Zelensky talked for about an hour and a half today, working on a solution to Russia's threat at the Ukraine border. Next, the White House says Mr. Biden is to conference with a group of 9 nations on NATO's eastern flank. The hope is for de-escalation with 100,000 Russian troops at Ukraine's back door. The New York Attorney General Letitia James is asking former President Trump to sit for a deposition related to a civil suit focused on his business practices. Letitia James also announced she will not run for governor of New York as planned so that she can complete the business at hand. And rapper Travis Scott gives his first interview since 10 people were killed at his Astroworld Music Festival in Houston back in early November. He talked about what he knew and what he didn't as the concert was playing out. Complete coverage and what he's told the victims' families on the news right after Jim Cramer, 7 Eastern, CNBC. Sarah, back to you, David, and everyone at Costco.
Are you a Costco shopper as well? Do you love it there too, Shep?
Where do you live in Manhattan? Where do you store
I
50
know.
of
You just have
something?
to pile up the boxes
Where
in
do
your
you
apartment.
store it?
You just find room.
Just pile
It's
it,
I
and
have
then
a very messy apartment.
and then the dog comes over, doesn't think it belongs there, and pees on it. I mean, where does this end?
I don't have a dog, just children.
Oh,
And when
well.
you have children, you just need a lot of stuff.
More
And that's what you get at
complicated.
Costco. I know. You have a cleaner place than me. Shep, thank you. Shep Smith. The European Commission scoring a big win recently against Google. The European General Court upheld a fine of $2.8 billion, which was set back in 2017. The court siding with the EU, saying Google favors its own comparison shopping service over competing services. I sat down for an exclusive interview with Margaret Vestager, who is the European Commissioner for Competition, and asked her what it means for the Commission and their pursuit against Google with many other charges. Listen.
For us, it is, of course, important when the courts side with us in our assessment in a case. And here the General Court sided with us almost completely. Now, of course, it is up to Google to decide if they want to appeal to the European Court of Justice. So that, of course, remains to be seen. But it is a good thing. And of course, when you realize it, because it has been quite some time since we took that decision. That was back in 2017.
So another case I wanted to bring up, which was the recent charges against Apple for allegedly distorting competition in its app store for music streamers. A lot of people, Commissioner Vestager, weren't surprised that you sided with Spotify on this one as one of Europe's largest and most successful companies. How do you respond to that charge on this one?
Well, actually, we have more than a Spotify case. We also have a general case about how does the App Store work when there is competition between an Apple service and other services. So this is not specific to Spotify. This is, I think, more a general feature. You see some of the same having been discussed in the Epics case. And here, you have also, I think, a U.S. company and a U.S. company discussing terms and conditions with one another. I think it's really, really important that when we have open markets and everyone is welcome to do business in the U.S., in Europe, that we do not make it a question about where you're headquartered, because then I think we'll miss a very, very important point when it comes to the openness of market and the fact that a contestable open market 20 years ago is also what allowed the tech giants to grow up to indeed be very successful companies.
Well, with Apple specifically, the company says that Spotify just wants to be able to advertise its alternate programs and services on the iOS platform, which Apple says no store would allow them to do. So they view it as completely unfair and nothing indicative of anti-competitive behavior.
Well, as one would have seen, we disagree. Of course, we're not done with the case. We have sent a statement of objection, and when we're analyzing the answers. But our concern is that you have one service, which is an Apple service, and you have another service, and the other service will have to pay a 30% fee, not being able to communicate with its customers outside of the app environment. So it's the unequal treatment between two competing services that we're aiming at here. And I think that is of the essence rather than, I think one should focus on that trading relationship instead.
You have also been pushing to get the Digital Services and Digital Markets Act through in Europe. What specific changes, if that does pass, if they do pass, can we expect from big tech operating in Europe?
Well, what we want to achieve is that markets are open and contestable, that more innovation can happen, that more investors in innovation see that it actually do depend on the ideas and the work ethics and the business model, also of smaller companies, whether they can reach their customers or not, and not in the dependency of a gatekeeper. So what we hope to achieve is, of course, a more dynamic digital market with more businesses having a fair chance of reaching their customers. And right now, the European Parliament have set their position, the European Council have set their position. So we are ready for the final negotiation. And if everyone works focused, it could come into effect by the 1st of January 23.
Why do you think Europe is so ahead of the US on this? We've heard a lot of tough talk against big tech, and you've been here meeting with fellow lawmakers and regulators. What's your sense of why the US is so behind?
That I don't know. I think that's just for US lawmakers to decide what they want to do. But in Europe, there has been a sense of urgency. We have seen that with the specific casework, the competition cases, the first Google case, the second, the third, the 2 Amazon cases, now another Google case, a Facebook case, 2 Amazon cases, 3 Apple cases. We see that the casework is not enough. We need to gain a different sense of speed in order for market power not to be misused to the detriment of smaller companies in that marketplace. And I think that that insight was quite clear by the end of my first mandate as Commissioner for Competition, and having a group of very insightful people also to look at whether or not our rules were fit for digital age. From that also came the realization that we need to complement what we do in specific cases with regulation that covers broadly and also ex ante sort of sets the rules of the game.
Well, as part of your mandate, you've also been scrutinizing some M&A deals, especially around startups. The Illumina Grail deal, for instance, looking into Microsoft and Nuance. It's sort of a broader oversight role that you're taking on here. What do you say to people who wonder if that actually will be counterproductive and ultimately cut off a key source of capital to some of these startup companies, especially in biotech, that need these big exit strategies?
Well, I think that's a really fair point because capital is indeed needed. And this is also why we have no policy, but we want to have a look. If you look at the Google Fitbit acquisition, we cleared that with remedies that would maintain sort of health data being held separate from data used for advertising, but also that the API remains open, so that anyone with a health device could still be, having the same access as Fitbit would have. And I think that's a good example of looking into a deal, assessing its competitive merits, and then finding solutions if we have a concern. And that, of course, is our approach whenever we see a case where a smaller company is acquired by a big one.
Finally, just to wrap it all up, how do you respond to critics that say Europe is becoming more protectionist, and they look at your office and some of your actions against American companies as a case in point?
Well, then I think they miss something very fundamental because Europe is open for business. Everyone is welcome, but we have one rule book. And I think even more important right now that we make sure that the market is open and contestable, since everything else digitalizes.
Margaret Vestager, the top cop on tech and other companies as well on antitrust in Europe. I've been interviewing her for 8 years, and I always ask that question about the protectionism because that is a complaint by U.S. companies and U.S. lawmakers as well, that Europe is just going after big tech because they don't have the kind of successful tech giants. And she always pushes back and says Europe's open for business, and then lays out a very clear strategy as to why she just wants to make it fair, which now U.S. regulators are trying to follow a little bit.
Yeah, they are somewhat behind there and focused on it. Always great to listen to those interviews, Sarah.
Thank you.
You're welcome. You're welcome. Up next,
Love having you here.
Up next, Mike Santoli, who she also loves to have near her, looks at how stocks could be impacted by rising rate hike expectations for next year. We'll be right back. Let's send it over to Mike Santoli. We've got to look at how rate expectations or rate hike expectations may affect the market. Mike?
Yeah, David, this from Ned Davis Research plots out historically how the stock market has done in advance of the initial rate hike in a cycle and then following. So here's your first rate hike. In all cycles, stocks have tended on average to do well, up, let's say, high single digits in the 6 months before. Nobody right now really thinks the first hike this time will come until at least 6 months out. So that tells you there might be a little bit of clearance for further upside. Now, the kind of hiking cycle matters a lot. Fast hiking cycles, stocks tend to struggle after the first hike. That means a hike at every meeting or so. Slow cycles, that's orange. You actually do pretty well if you have breaks between rate hikes at different meetings. And then non-cycles, that's basically when there was never a recession before the first hike. Now, take a look at what the market is pricing in right now, both in terms of how many hikes are ahead, perhaps in the next 12 months. That's your blue line there. And then also how it's diverged here from ultimately how high rates will get, how many hikes there will be ultimately in this cycle. That's come down. Basically, the market is saying, yeah, we're going to get into a hiking cycle, but it's not going to last very long or go very high, perhaps because the Fed has lower tolerance for having unemployment go up or because of demographics or other reasons. So that's kind of interesting and why maybe the cycle doesn't look that scary from here, Sarah.
Pushing back against the rate hikes kill rallies.
That's right.
And
the first
economy.
one doesn't. Maybe eventually. Yeah.
Mike, thanks. Broadcom moving higher after reporting just a few moments ago. We're going to break down that move with an analyst who is pretty bullish on the stock. And check out BuzzFeed, as we had to break, went public this week, falling nearly 25% in today's session. I think it's fallen every day.
Yeah, the 94% redemptions for the SPAC, they basically ended up with virtually no cash to spend on their growth initiatives because it all went back to the trust holders.
There you go. I knew you would know something about it. BuzzFeed finishing lower by 24%. We'll be right back.
Shares of Broadcom, as you see, up over 5% at least in the aftermarket. This after the company reported earnings that were ahead on the top and bottom lines. Also announced a $10 billion buyback. Let's bring in Stacy Raskin, senior analyst at Bernstein Research. Good to see you, Stacy. Real quick, what's struck you from at least reading the release so far? What you've seen?
Look, there's nothing here not to like, really. This is a great report. Nice solid beat in the quarter. Very big raise. Like Broadcom, quite often they usually beat, but it's usually by not too much. This is a material beat. Took up the dividend 14%. They're going to be paying out $16.40 a year next year. So it's creeping up on a 3% yield here. I mean, it looks good. $10 billion buyback, as you mentioned. We were expecting some kind of return of the cash, either M&A or buyback. They couldn't find anything to buy. It looks like they couldn't find anything to buy, so they're giving the cash back.
Yeah.
But in general, like I said, there's really nothing here not to like. This is a great report.
That's interesting, though, your point. I mean, the company obviously has grown not largely, but M&A has always been a really important part of strategy.
It still
Have
is.
they kind of reached the end here? Is antitrust potentially also a gating issue? What do you think?
No, I don't think so, because remember, they're not buying semi companies anymore. They're buying software companies. And that may have been part of the reason, in my opinion, that they made that shift. But they've been building out their acquisition strategy around rolling up sticky, mission-critical enterprise software businesses. They've been on the hunt. We know that there were some rumors earlier in the year they were looking at some other assets, but they've been telling us all along, our preference is for M&A, and that is the strategy is half the cash flow goes to the dividend, half goes to M&A, assuming they can find something. They can't find something, eventually they give the cash back, and so that's what they're doing this year. And by the way, I'm fine either way. I'm a little more partial to M&A simply because they're really good at it. Like, I like to see them buy stuff, but I'll take a $10 billion buyback too. That's fine.
All right. Well, apparently shareholders will as well, although we'll be watching you closely tomorrow morning. Stacy, thank you.
Yeah, you bet. Thank you.
Already outperforming the whole S&P IT index for the year. A key inflation reading due out tomorrow could have big implications for the Fed and your money. The number you need to watch next. Tomorrow's going to be a biggie. Key inflation data on deck. The Consumer Price Index report, which will be top of mind for Fed officials and elected officials and investors heading into the last Fed meeting of 2021 next week. CPI forecast to rise 6.7% from last year in November. I've heard whispers of 6.8% versus 6.2% in October. So that's a jump. The core CPI rate, which excludes the volatile food and energy prices, expected to jump 4.9% from last year. Those numbers due out tomorrow morning, 8:30 a.m. Eastern. We'll see how the market absorbs it and whether, to your last chart that you just showed, there's any change in expectations for Fed. Is it consensus now that the Fed next week is going to speed up the taper process to end it in March instead of June?
I think March is now where the expectations are coming together. The tricky part is, and we've been saying for a while right now, nobody really expects the year-over-year numbers to calm down before, let's say, March, because of going up against really weak inflation numbers a year earlier. Now, the month-to-month matters a lot. We already have the 2-year note yield pretty much at the high, so that's already repricing for, a couple of hikes next year. So it's not like the number tomorrow should necessarily really change that story, but it's a matter of the sticker shock effect and whether there's some expectation that we already are pricing in a little bit of a cooling off of inflation that has to be taken back. So I don't know. Maybe it says more about which types of stocks over and underperform than it will about whether the overall market can handle it.
What will you be watching tomorrow?
Jim Cramer talking, mostly. That's what I watch.
So you did your homework. Broad comes up, Lulu's
ready.
up,
Broadcom,
Chewy's
Costco,
down.
Lulu, I'm all good.
Costco's up. There you go. Pays to watch Closing Bell and Squawk on the Street. That's going to do it for us tonight. Fast Money begins right now.
Live from the NASDAQ market site overlooking New York City Times Square, this is Fast Money. I'm Carl Quintanilla in for Melissa Lee. Tonight's trader lineup, Guy Adami, Tim Seymour, Karen Feinerman, and Dan Nathan. Tonight on Fast, a sleeper stock ready to rise and shine. Kathy Wood's making a bet on this name, but should you? We'll tell you what it is and how to play it. A Bitcoin breakdown, the crypto on pace for 4 straight weekly losses. A sign of more trouble, or is it time to buy in? And the new kid on the block, Berkshire-backed Brazilian bank, comes to market at a tough time for fintech, but one of our traders is bullish. We'll find out why. But we will start with the countdown of the most important inflation report of the year, tomorrow CPI, and what it could signal to the Fed. Last month's read was a 3-decade high. Economists expect an even higher number this time around. Could this spook the markets having their best week since February? Guy, what do you think?
Well, look, before we even get into it, you can't just start that way. So if we make it to January, it's 15 years. That means we've done 3,300 shows over that time. And this is probably, the third time you've hosted? I mean, you are Carl Quintanilla. I mean, this is like, you're on the Parthenon of CNBC. So for me, I know I can speak for the others. I'm just like flabbergasted. Okay, what was your question? Right. Oh, can the market be spooked? Absolutely. And if this thing has a 7 handle, and that's not out of the realm of possibility, I think the market absolutely gets spooked. The only thing I think the market has going for it, Carl, is the fact that the Fed's now in front of this, not behind it. Obviously, they've taken the word transitory out of the lexicon. So I think in terms of that, they're prepared. I don't know what to expect. And quite frankly, and Karen can speak to this, even if I knew the number, I wouldn't know what to do in the market.
Yeah, Karen, that is true. I mean, is there a different playbook for what if it's hot and what if it's cold?
I'm not sure what to do, as Guy said. If it's really hot, I think that we know that the Fed is going to increase the pace of the taper. That's baked in. But if it's not so hot, are they already committed? Do they increase the taper anyway? I think they do, right? They've made their position known. They've primed the market for it. I think they should. But I think a really hot number is more likely. And I think that spooks the market. I just think those high flyer stocks, those multiples can't continue if rates are higher. So that's sort of how I'm positioned. I think that even though inflation might be transitory, is not the word I want to use, might go down a little bit, it's still very, very high. So I'm positioned for lower PE stocks. That's where I want to be.
Yeah. Tim, there had been some talk that CPI would reflect oil coming down, maybe some shipping rates coming down. And then the president comes out this morning and says this print might not reflect any of that. And that's really where stocks started to run into trouble today.
Yeah. By the way, welcome, Carl. I agree with Guy. It's great having you. And the point on CPI for tomorrow, though, this is so well flagged. And I think we also do understand, even people that haven't spent a lot of time understanding the differences between core and the headline print. I actually do think that wholesale retail gas prices are going to fall off dramatically in the next couple months. I do actually think that some of the food prices, which are up, going to probably show a 0.5% rise in November, are things that are unsustainable. So while I'm not going to use the T word, I will say that I do think that the market now has almost been I wouldn't say inured, but I think we expect inflation is with us. I agree with the traders that think that CPI inflation is a concern for the market, but the bigger concern really has been around growth. So I think it's more an impact really of what we think the read is going to be for the Fed for next week. And as much as we want to handicap that, I think the Fed, the 180 turn in the Fed posture in the last 3 weeks is something that we don't necessarily know what we're going to get coming out of that Fed meeting.
Yeah. Dan, one narrative making the rounds today was the CPI print, really isn't where the risk is. It's more about the market getting comfortable with the withdrawal of accommodation in general for the next several years, regardless of what tomorrow's number brings.
Yeah, and really, that's something, I guess, if you've traded over the last 13 years, it was something that was always on the tip of your tongue. In the years following the global financial crisis, there was a lot of volatility. This time around, I think we all know. What did Fed Chair Powell do in December of 2018 when the stock market started to get rallied at the pace of the rate increases? He went dovish, right? And the stock market soared. So I wouldn't expect that playbook to be the same exact one right now. I think that's one of the reasons why we haven't had a whole heck of a lot of volatility, because I think we do know that if the stock market goes down too fast, too quickly because of the taper or expectations for rate hikes, the Fed will change their tune a little bit. And I'll just say this, if you're thinking about how to trade this, okay, into the CPI number, I'm with Tim. I think like all this stuff's going to revert. I think that, in 3 to 6 months, we're going to be talking about, we will say, oh, that was transitory. It just mattered whether you meant 3 months, 6 months, or 9 months. It doesn't really matter. I don't believe that this pandemic changed the way our economy is going to work for good going forward. The last thing I'll say about the stock market, look at what happened today. Why did Microsoft, why did Apple, why did Alphabet, why did they trade so well relative to all these high growth names? The NASDAQ 100 was down 1.7%. Most of those names I just mentioned were down, less than 0.5% or so. So you're seeing the continued crowding into those names that should be, I guess, somewhat, should be insulated from runaway inflation, I guess. So to me, I find that dangerous, though, because I think the crowding in those names and the absolute devastation in so many other parts of the market is not a great setup.
Interesting. So, Guy, does that mean that essentially the Fed put, as we've known it for years, is dead, is just too costly for the Fed to continue, and we're going to continue to crowd into large mega cap safety names that will sort of cloak the underlying pain in a lot of the stock market?
It certainly feels that way, but just let me push back on Dan for a second. He mentioned October, November, December 2018, much different time. Then the Federal Reserve, I think, was getting sort of browbeat by the administration, and the report card for that administration was the stock market. So when the stock market went down 19.9% in about 2 months, I think they got forced into doing something. It's much different now, and Karen brought this up last week. This seems to be an administration that's not as much focused on the stock market. Right now, the bullseye they have on their back is inflation. And the first comments Powell made after his nomination was about inflation, which I find fascinating. I think they're more focused on that, which could really hurt the market in the long run. So to answer your question, yeah, I don't think that Fed put is in place as much as people would like to think that it is.
Yeah, Karen, I missed that comment, but you made note of the fact that it was his first comment out of the box.
Yes, and it was quite clear. I mean, he couldn't have been more clear. This is what we're going to do. And then he did it again the next day. And then Loretta Mester came out. And then there was another president of the Fed that came out and said the exact same thing. So I don't know. It seemed to me rather interesting, coincidental, I guess, on the timing. But let me just say one thing about the Fed put. Even if the Fed does reduce their taper, it's still a very accommodative Fed, right? Rates are, zero-ish. And they're still buying some, even if they reduce the taper and in March. It's still a very accommodative thread. It's not, I don't see, huge hikes in us getting back to 2 or 2.5 in the near term. So we're just so used to zero financing that now it seems like, if we take that away, wow, this is terrible. I don't know that it needs to be terrible, but people are going to flip out.
Yeah, but we're going to find out in the morning. For more in the meantime about how tomorrow's print might impact the Fed, let's bring in Steve Leisman. Steve, I assume you've been listening to our conversation. What are your thoughts going into the morning?
Yeah, I want to know why Guy said if we make it to January, is something going to happen? I was worried about that comment. I think we're going to make it to January, Guy. I wouldn't worry about that. So that's the first thing. Look, this is going to be a bad number, and I will say this: be very careful because economists do not have a very good feel for really predicting this economy. Last month, the print was double the expectation on the headline. 0.3 was predicted, came in at 0.6. I think whoever said, maybe it was Guy, that if we may have a 7 handle on this, would not be out of the ordinary. And the problem here is not, somebody else said, that it's baked in. I think that's right. The risk is what's not baked in here, that you have a wave of two things could possibly be happening, maybe even three. The first one is a wave of additional housing inflation can come through. The housing costs that are out there, not in the CPI, look like they're rising faster than those within the CPI. You also have another wild card when it comes to the used car prices, and the auction rates have been pretty strong there. The other thing that's not necessarily reflected in there is wage inflation. Those are going up. You look at 11 million job openings, it tells me we have not reached equilibrium on wages yet. We still have some adjustment to do. And once we adjust the wages for the rank and file workers, there may be another wave of inflation that comes from, hey, the managers turn around and say, well, if that guy's making this, I ought to be making that. So that's another wave of inflation. There's more to come. I think that is what is behind what Tim was talking about. I guess I did listen to all of it. This idea that the Fed is going to be much more hawkish when it comes to inflation right now, and they're going to position themselves essentially to respond to this. That's why they're getting the taper done early, and that's why they're talking openly about 2, possibly 3 rate hikes. If you look at the probabilities there, we've got 2 pretty well priced in, 3 pretty well priced in for next year. And I think Karen's right that if that's it, it's not that bad. You talk about a 75 or 80 basis point Fed funds rate next year, not the end of the world. The risk or the threat here is, do they have to do more than is priced into the market?
Steve, I hate to play the hypothetical game, but, we see short squeezes in everything we do. Traders buying the top because they can't stand it anymore. And something happened, I think, with Jerome Powell. He said, they're going to retire the word transitory, which is fine. But here's my question to you. If that number tomorrow comes in really soft, let's say, low 6s, high 5s, the first question he's probably going to get, to the extent that there's a Q&A, is, did you retire transitory too quickly? How does he respond to something like that?
I think he responds to it by saying, I look around at the risks out there, and the idea of risk management is a tried and true and traditional way for the Federal Reserve to run policy. And I look at the risks out there and I say, the risks are to the economy are to higher inflation. Look, you guys should step back and I think appreciate the uniqueness of the situation we're in. We not only have high inflation, we have good growth, and we have good earnings growth and exceptional profit margins out there. When you look at profits as a percentage of total GDP, we're at all-time highs. I'll throw a question back at the group here, Carl. If you knew 6 months ago or a year ago that inflation today was going to be 7%, how would you be positioned and made money any differently? You would say, I would think, that you'd get out of the stock market, you'd short the whole bond complex. I think it's a unique situation of strong growth, strong earnings growth, and high inflation. So it's not that inflation is the only economic story out there. You have to deal with the other side of the balance sheet, which has been pretty good for companies right now.
Steve, I wonder, this jobless claims number this morning was remarkable, 52-year low. Stock market, a couple percent from record highs. GDP, Atlanta Fed's looking at 9% for Q4. Does anyone at the Fed think current policy is ridiculous? We would change it today if we could, but we have to soften the market in order to do so?
Yeah, Jay Powell thinks that. And whoever said, that the first word out of his mouth was inflation. I think a lot of folks have come to the conclusion that this economy does not need this kind of stimulus, at least through June. And the only reason I think they're still doing it is to give the markets time to adjust. I think if they had their druthers, I know a bunch of them that would get rid of it right away. And they're just trying to follow through on their promise to markets to be transparent and to move all this stuff gradually. What they're doing now and this turnabout, which, by the way, came from the November inflation report, which said two things. It was higher than they thought or it was going to be, and it was more widespread. That's really the key. I'm going to look at this number tomorrow. I'm going to look at the diffusion of gains out there. Is this an aggregate price or are these just a couple things? If it's just a couple things, I think the Fed would be chill and say it's transitory, it's going to run off. But if it's widespread, that's going to be a really important aspect tomorrow. And that's why I think ultimately they're going to be more hawkish, move to those rate hikes, try to do it gradually, but they're going to get there.
Yeah, we'll find out in the morning, Steve. That's a great discussion. Thanks, Steve Leisman. What does a faster taper and higher rates mean for corporate bondholders? Let's find out. Trade school's in session. Let's bring in BondClick CEO Chris White. Chris, let's talk about what kind of impact this might have on the corporate bond market.
Well, thanks for having me on. I think that that's actually something that the Fed is going to have to seriously consider when they talk about implementing their policies for raising rates. They've already started tapering when it comes to direct bond purchases. They stopped buying corporate bonds and actually sold their positions out in 2021. And they've really tapered when it comes to buying treasury bonds and mortgage bonds. And what this effectively does is it starts to change the value of corporate securities in the marketplace as people anticipate that the real interest rate environment is going to be higher, and therefore current corporate bond holdings lose a lot of their value because they're paying such low yields.
Because it's Karen, let me ask you something. If we get a really hot number tomorrow, do you think the curve will flatten more or possibly invert, or do you think the whole curve will move up, the slope will stay the same? How do you think this plays out if we get a hot number?
Look, I think that anytime we talk about moves that are happening in the marketplace and we're in like close to mid-December, I think everybody needs to relax in terms of what it means for the broader future of the marketplace. Things get very, very choppy in December because traders are on vacation. People are trying to book profits in this calendar year so they can get paid. So I wouldn't overreact to any moves that happen on the yield curve coming in the next few days. What I would look for is in the beginning of Q1, what's the trading activity? Are you seeing a lot of movement out of longer dated maturities into shorter dated maturities, which would really steepen the yield curve? Because that would be an affirmation that people think that rates are going to be raised possibly pretty aggressively, and they want to make sure that they've got powder dry so that they're going to be able to buy those bonds that have juicier yields in the future.
Hey, Chris, it's Tim. Thanks for joining us. I'm going to change gears a little bit because you're also a credit guy. 2 weeks ago, we had high yield spreads at 9 to 12 month highs, or wides, I should say. And while I don't think we're anywhere near a credit problem right now, ultimately, we also talked about scenarios from 2 years ago. Guy brought up the Fed policy and whatnot. 2 years ago, we were talking about that large kind of tranche of BBB minus that was, on the edge. What point do you see credit becoming an issue? And did you see any of that weakness, at least in some of the lower grade stuff a couple weeks ago?
Well, we've had a year where junk bonds have had a tremendous year in 2021. With tons of issuance, and also they've just improved in value. So if you see a little pullback, that's only natural here. We've seen double B spreads that at levels that we've never seen before. But actually, your question's a great one because the Fed is in a really precarious position here because something we're not talking about is the wall of debt that is maturing from not only U.S. corporations, but there's about $72 billion in emerging market debt that's maturing in 2022. If the overall global interest rate environment raises or rises too quickly, a lot of these junk bond corporations or junk bond emerging market institutions that need to retire their debt in 2022, they may not be able to refinance at favorable interest rates, which could start to raise the default rates. How this impacts the U.S. markets is what we've seen is in this sort of area where yields have been really hard to capture for asset managers and pension funds. They've had to buy emerging market debt in order to sort of hit their yield bogeys or their performance bogeys in fixed income. And you all remember like what started to happen when Chinese real estate companies started defaulting. We're finding out that lots of American asset managers had significant positions. So these are the things that the Fed has to consider. It's not just what's going to happen in the domestic markets. they've got to really think about just how broad investing activity has gone outside of the United States and how their interest rate policies are going to impact those companies as well.
Yeah, no, definitely throw a very large rock into the pond. There'll be a lot of ripples. Chris, thank you. That was great. I appreciate that very much. Let's trade this, Dan. I mean, what are your thoughts coming out of that? When you think about new issuance, have corporates assembled enough dry powder for now, or will they sense the window closing?
Yeah, no, I think that's a great point. I mean, corporate balance sheets are obviously in a really good spot here, but I'll just say this, Carl, you're new around here. I'm easily the dumbest guy on this panel on any given night, but I'll just tell you this, man. Steve Leisman categorized the economy as rocking and rolling. But listen, we threw like $5 trillion at this pandemic, right? And so why are those balance sheets the way they are, both business and consumer? If you look at GDP expectations for next year, when I hear about margins, corporate margins where they are, they seem like it's a peak sort of scenario, especially when expectations for rates are higher and all that debt that we have right now. I don't think rates are ever going meaningfully higher, but I also think growth is going to disappoint next year. If you think about Goldman Sachs just lowered their 2022 GDP growth below 4%. You know what we were averaging pre-pandemic after the financial crisis? About 2.2%. In Q3 and Q4, they're expecting GDP to have a two handle. That's where we're going back. And we are choking on debt, both corporate and sovereign. So I just think growth is going to disappoint. And I just think it's going to be a tough environment for stocks when you consider the performance that we have had over the last 2 years and how much capital it took from both the Fed and obviously the Treasury and Congress just to get here.
Right. That's going to be a longer, harder question to answer, Dan, for sure. Coming up tonight, we're all over the after-hours action in some earnings. Oracle, Broadcom, Lulu, all on the move after reporting. We'll get details coming up. First, the digital bank startup backed by Berkshire going public today. We'll dive into how Nubank fared in its first day of trading. There's a lot more fast money after this. Welcome back to Fast Money. Brazilian fintech company Nubank making a blockbuster debut today. Shares of the Buffett-backed digital banking company jumped nearly 15% from the IPO price. Let's get to Kate Rooney for some details. Hey, Kate.
Hey, Carl. Nubank seen that double-digit pop on its IPO day. Shares of the Brazilian fintech closing above $10 in its first day of trading after pricing at $9. That was at the high end of its expected range. It's trading on the New York Stock Exchange under the ticker NU, NU. And Nubank made its name as the most valuable private Latin American tech company in what's known as a challenger bank. It's now valued at more than Brazil's largest incumbent bank. And this was a big milestone for the growing cohort of startups in Latin America. The company is led by CEO David Velez, and he and Nubank really have been the gold standard of how to build a high-growth tech company there and attract high-profile investors. Nubank's pre-IPO backers include Warren Buffett's Berkshire Hathaway, you've got Sequoia, Tiger Global, and Peter Thiel's Founders Fund. And there have been a flood of investors and capital to the region. So far this year, Latin American startups have brought in just under $15 billion in VC funding. That's a threefold increase just from a year ago, according to CB Insights. But in public markets, some of Nubank's public comparisons have struggled lately. Take a look at dLocal. That was a hot fintech IPO this year. Mercado Libre, Stone, another big one, all in the red this year. Stone is down almost 80%. And a tough few months for some of the flagship U.S. fintechs as well. Square and PayPal are also both negative for the year after big years in 2020. Investors have been rotating away from growth lately, as you guys know, but those stocks also negative on the year. Carl, back to you.
All right, fascinating debut, Kate. Thank you, Kate Rooney. Tim, what do you think? Let's trade it. Is this a Brazil play or a fintech? Is fintech universal anywhere at any country?
Well, it's the right question to ask. It's also the right question to ask and the right IPO to talk about it on a day when the Brazilian central bank raised rates 150 bips and is well ahead of the Fed and has raised rates 700 basis points in the last 7 or 8 months because of endemic inflation and a concern and look, a banking system that historically has been on the brink. And so while Nubank has a bigger market cap than Banco Itaú or Bradesco or the juggernauts down there, this is a bank that really has already moved ahead of so many banks, not only in Latin America, but around the world. And again, David Velez understands the dynamic. And by the way, this is a financial institution. This isn't just a tech story, and this just isn't fintech. And I mean, this is giving folks their first access to credit cards, their first access to bank accounts. In the EM world, this is a story of leapfrogging both technology and immediately arriving into a place where I think this platform will be very sticky for a lot of other fundamental banking endeavors, but also, yes, very disruptive tech and digital access and et cetera. I think this is absolutely a global play, and this is a financial play because, again, in EM, so many people are underbanked, and these guys move a lot faster than the incumbents. It's an exciting day.
Interesting. Yeah, certainly an outlier given today's price action. Look at that screen right there. The only one in the green. We're just getting started here on Fast Money. Here's what's coming up next.
The earnings keep rolling in. We're all over the after hours action in some big names. The details are next. Plus, a crushing day for crypto as the big coins head south. So what's next for the space? You're watching Fast Money, live from the NASDAQ market site in Times Square. We're back right after this.
Welcome back to Fast Money. Got an earnings alert for you on Oracle. Shares are higher by about 10%. Conference call underway. Let's get to our Julia Borston. Hey, Julia.
Well, Carl, Oracle shares shooting higher and better than expected top and bottom line results. The company's biggest division, cloud services, grew 6%, and the company authorized a $10 billion increase in share repurchases. Now, what's sending the stock even higher, you see that leg up during the earnings call. CEO Safra Catz saying that revenue growth will accelerate. She guided to 6 to 8% fiscal third quarter revenue growth in common currency. And she said that full year revenue will finish solidly in the mid single digits. Now, Catz saying that cloud bookings growing faster than the cloud revenue growth rate. And as a result, they expect cloud revenue will accelerate further and exit the fiscal year in the mid 20% range, potentially higher. She did note that cloud is a more profitable business than their on-premise business and that their margins will be better than pre-pandemic levels. Larry Ellison, bullish as well. He pointed to the particular strength of Oracle's autonomous database and also their MySQL database divisions, saying, quote, because of their extreme high performance, both products present huge growth opportunities for our cloud infrastructure businesses. So some positive commentary about the fiscal third quarter and looking into next year is what is sending that stock up now over 10%. Guys?
All right. Thank you very much, Julia Borston. Let's trade it, Guy. What do you think, especially in light of what's happened to enterprise software names in the last 3 weeks?
Guess who's now a cloud growth company? Yes, you guessed it, Oracle. I mean, 47% operating margins. Now, it looks like Fusion ERP, 8,500 customers, revenue growing 35%. NetSuite, 28,400 customers, revenue growing 30%. It trades at a pretty much a market multiple, maybe a little bit north of that, with growth that is just off the charts. This stock should be north of $100 off the back of this earnings release, and I can almost categorically guarantee that analysts who have been behind the curve on this are going to raise their numbers over the next couple of weeks.
Well, we'll find out. Meantime, Broadcom, guys, surging after its report. That call is also underway. Our Josh Lipton has those details. Hey, Josh.
So remember, heading into this report, Broadcom was already up about 30% this year. It was trading right around its all-time high. Now reporting Q4 results here, beat on the bottom. Revenue $7.41 billion versus $7.36 billion expected. Q1 revenue forecast about $7.6 billion versus $7.3 billion expected. Bernstein's Stacy Rasgon telling me this was a solid beat, a sizable guide up, gross margins good dividend raise, and the company announcing that $10 billion buyback. There is nothing here not to like, Stacy says. His rating outperformed, attractively valued, better control over the semi business than rivals, a less volatile software business, the highest margins and free cash flow in the space, Stacy tells me. On the call, CEO Hock Tan saying enterprise demand rebounded sharply. As for wireless, strong wireless growth driven by the launch of next-gen phones by his North American customer, and by that he means Apple. Turning to software, growing 8% year over year, reflecting that strong enterprise recovery. We are well positioned, Hock Tan saying, in every franchise market. Back to you guys.
All right, Josh. Thanks. Great. Thank you, Josh Lipton. Let's trade Broadcom. Dan, can you find any hair on this print?
No, there's no hair on it. Another $10 billion buyback here. We just saw Oracle name that same number. And, again, here's a stock that's trading below a market multiple. I think the problem that you have here, Carl, is that the stock has rallied 23% in a straight line in just about 2 months. I mean, when this stock was consolidating down near 500 in mid-October, you could say that was trading cheaper then if you had an optimistic outlook about maybe just dealing with supply chains better. That was the time to buy it. I just don't know how you chase it up here at an all-time high with this news out. I would say one thing to extrapolate, a lot of people have been scratching their head. Why has Apple been so strong of late? Well, they're a 20% customer of Broadcom here. So this is obviously good for Apple here. Again, you draw a line for the March lows. You see a nice uptrend there. There's a place to reload on this name. It's probably not here at $620.
Hey, Tim, I'm watching your reaction off camera. What do you think? Is it too late?
Dan, I wasn't shaking my head at you. No, look, Dan makes great points about the move the stock has, and he also made points that the stock didn't do anything wrong, and that the valuation, 18, 19 times, very cheap. Again, as Dan pointed out, I just think sweet spot of data center networking. They, like Marvell, proved that they're less susceptible to supply dynamics. I think they can kind of do what they want here. And yes, they are goosing the stock by buying back and increasing the dividend. So I think that gives you reason to stay in this name. Secular tailwinds for these guys, by the way. I mean, I think they actually have trailed some of the move in the big data center plays. And I think you stay with these as some of those get a little bit more competitive.
All right. Last but not least tonight, Lululemon shares are losing their earlier gains and have gone negative. Courtney Reagan's all over that one. Hey, Court.
Hi, Carl. Yeah, the conference call is still ongoing, but wrapping up here. Lululemon turning in a stronger than expected earnings and revenue number for its fiscal third quarter. Full year earnings guidance a little light, revenue in line. The CFO notes that the company did raise guidance even with more conservative revenue expectations for its mirror business and increased costs for air freight. They also note that while there are several large volume weeks ahead of us, we still feel well positioned for a strong end to 2021. Revenue grew 28% North America, 40% internationally, calling out China specifically for strength. Total comparable sales growth of 27%. Store comparable sales grew 32%. And when you're looking at the portion of online versus in-store, online sales ended up making up 40% of total sales for the quarter. Lululemon's gross margin did improve 110 basis points to 57.2%. And the CFO noted that markdowns declined when compared to 2019. Shares are down here just about 2% after hours, still up about 20% year to date, but fairly rich valuation on this one. Carl, back over to you.
Yeah, thanks, Court. A lot of cross currents in this one, Karen. You got the dispute with Peloton over Mirror. Of course, a lot of backdrop of are we going to need new clothes to go to work or not? What do you think? Let's trade it.
So, I mean, there's a lot to like in the report. The gross margin, as Courtney pointed out, that was good. So less promotional or a better mix or some of both. The full year guidance, a little light, particularly since this quarter was fine, and yet the guidance didn't go up by as much as this quarter beat. So that made it a little light, but they might just be sort of lowballing. All that being said, though, you know, at 55 times and just trading at a less than 2% free cash flow yield, they're priced in for perfection and they've delivered it. But what if they don't? So it's too rich for me. It's obviously a great company. I wouldn't short it. It deserves to have a premium multiple. Whether it deserves to have more than a 2x the market multiple, that's too rich for me. So love the company, but can't own the stock at this price.
Guy, you in the same boat?
Love their products. I won't get into great detail, but I think Karen's spot on. You're looking for an entry point here. You're not shorting it, but you're looking for a place to buy it. And I think that comes in the form of the October 21st low, which if memory serves was 385. That's where you get into the name.
All right, we'll see what happens tomorrow. Right now, 407.50 after the bell. Coming up, ARK Invest Cathie Wood weighing in on Twitter today, calling the social stock a sleeper. Is this stock's performance a dream or a nightmare? We're going to dig into that trade in just a few. Plus, the crypto carnage, the major tokens take a leg lower. We're going to break down the moves in the space. Don't go anywhere. Fast Money's back in 2. Welcome back to Fast Money. Bitcoin lost some steam today. The cryptocurrency dropping more than 5%. Ether down nearly 5.5%. The two biggest crypto assets now on pace to end the week lower, despite making a slight recovery from that wreck over the weekend. Bitcoin is now more than 30% off the all-time highs hit in early November. Tim, on Saturday morning, that number was closer to 40. How much do you think is being flushed out here in a good way?
Well, if you look at the drawdowns in Bitcoin over the last couple of years, 30 to 35 to 40% is almost garden variety, certainly going back over time. If you look at the chart and you could draw an uptrend going back a couple of years, you could say, down to 41,000, not bad. And I think the conversation around Bitcoin is really now more of a conversation about it being called the proxy play for the blockchain, and the dynamic around blockchain that nobody is questioning. And certainly some of the financial institutions that we'd be talking about, I'm sure they'll tell you that they expect to be doing a lot of their settlements and ops are all going to be blockchain related. Settlement will be blockchain. So, Bitcoin as the proxy, not a surprise to the extent that we're also having a Fed heavy discussion and concerns about inflation and less liquidity. I think this has to affect the price of Bitcoin, and again, the people that trade it. So not totally alarmed, and I bet most people holding Bitcoin not terribly alarmed.
Dan, the technicians, of course, have long said the charts have not been stellar going into this last quarter of the year, and we've seen a lot of year-end 100K targets go to waste.
Yeah. Well, Carter Braxton Worth had a note out yesterday talking about the relationship between Bitcoin and Ethereum, and very bullish on Ethereum. He thinks that it's setting up for a really nice breakout. The relative outperformance this year is pretty staggering, with ETH up about 450% versus Bitcoin only up about 65%. You see ETH consolidating here. If it can kind of keep it together a little bit, I think what Tim was kind of alluding to is that a lot of the really interesting stuff in crypto-related, blockchain-related stuff is going on with smart contracts right now, whether it be Ethereum or Solana. And right now, Ethereum is about 55% of the market cap of Bitcoin. And so I think there's a lot of people who are thinking about NFTs. They're thinking about ways to unlock Web3, creator economy stuff, DeFi, and that's all built on Ethereum or a smart contract blockchain like Solana. So to me, I find Ethereum very interesting. I like to have pullbacks on it because I like to buy more. I have a longer term outlook. I'm not really trading it. I don't really think of Bitcoin that way because to me, it really feels like that digital store of value, digital gold, and I was never a buyer of the gold like Guy Adami.
We're going to talk about Cathie Wood in a few minutes, Karen. But she did say this morning on Squawk that if big institutional money came into Bitcoin over the long term, it could add $500,000 to its value.
To each share, to each coin, rather.
Yeah.
That's a lot. That's clearly a lot of value. That would be up, 11 times from here. I'm not sure where that comes from. I mean, I'm a believer in digital currency. I'm a believer in Bitcoin. I'm a believer in the idea that, fiat currencies, if we just keep printing money, that could end up being problematic. And the institutional adoption and needing to have crypto exposure, as I do. But as Tim said, this is sort of a garden variety pullback. I don't know where that $500,000. I hope to God she's right. That would be pretty amazing. But I don't think it needs to go there for a lot of people to make a lot of money.
Yeah, that's for sure. Speaking of which, coming up, Cathie Wood betting the Twitter stock is going to fly. Are the traders buying that pitch? We're going to find out next. And CVS hit a new high today as it says sales will accelerate in the new year. That has some options traders piling in. We're going to tell you how they're trading the name when Fast Money returns.
There is a sleeper in Twitter that we think most people don't understand. What we're seeing is that this platform, which used to be dominated by tweens, teens, and celebrities in 2012, when we first evolved our research ecosystem, has now evolved to knowledge workers. And we find it essential at ARC to engage with the communities we are researching and actually to become a part of those communities. This is a very powerful social network.
That's ARK Invest Kathy Wood speaking to Squawk Box this morning about why her flagship innovation fund picked up shares of Twitter. You can check out that full interview online at cnbc.com/pro. Twitter rising as much as 5.5% today, but if the stock's a sleeper, it's having a nightmare, down nearly 15% for the year, now without its longtime CEO, Jack Dorsey. Dan, what do you think? Is she right? Is the stock about to pick up?
Well, she's right about the fact, the importance of the platform, and we're all power users, so we recognize that. And I think, we've all been very constructive on the story, but the stock has been really hard. I was very disappointed when I saw the news. I don't think anyone was disappointed that Jack left. I think it was probably time, but their choice, the new CEO, I think is disappointing when you consider their inability to come up with good technology to better monetize and grow their user base. That's it. That's the problem. So I don't know why you would promote the CTO to be the CEO of this company. So I'm no longer in the name. I think we're going to see lower lows. I think we'll see the stock below 40. She could be right if there's another evolution of this company, but they have been unable, I think they call it daily monetizable active users. I mean, they are on this 200 million bound, and I just don't really see how they're going to be able to better monetize it. We've seen a lot of new products this year. They've got rid of some that haven't worked, fleets and this and that, or whatever. Let's see super follows. Let's see spaces. There's some interesting stuff, but I don't see them getting to 500 million users based on those products.
Yeah, those long-range targets are sort of what even the bulls, Tim, say is at risk. And they also point out, engineering fixes aren't something that get solved or show their worth in the quarter or two.
Yeah, I agree. I mean, look, it was just that investor day back in February, not that long ago. They said they're going to double revenues in 3 years to 3.7 to 7.5 billion, that they're going to get to 315 million DAUs. I think there's a credibility problem from management. I mean, they've said a lot of things over the years and never hit them. I mean, and yet going into that investor day, the stock almost doubled. So I think there's a lot of investors that really bought into that. And I think the re-rating that went on was a mirage. And I think they need to prove it.
Guy, they've been through sort of the kissing machine regarding speculation of a takeover, whether it's Microsoft or Salesforce. We've all heard these scenarios being spun. But do you think there's a likelihood that someone takes a fresh look at it, given sort of the societal liabilities you'd have to put up with owning this thing?
I've never been in one of those machines, so it's hard for me to comment on that. I think the answer to that question is absolutely yes. I think it's too valuable an asset in this environment. And, Tim just mentioned the $7.5 billion. I think they'll get there by 2023. And if you start doing the math at current prices, they're trading about 5.5 times revenue, which, given if you look at it against their peers, is sort of cheap. So I'm with Kathy Wood on this one. I think JP Morgan just came out and said they could see the stock doubling. And I think your point about M&A, I think that's sort of the cherry on top. So I actually like the name here. I'm in the Kathy Wood camp. I'm not in the kissing booth or whatever you just mentioned before.
Well, good luck on that. Still to come, we're going to check in on CVS options next. How one trader's betting today's gains may just be the start of where things are headed. Those details are next. You're watching Fast Money live from the NASDAQ market site in Times Square. We're back after this. Welcome back. Here's a sneak peek at the Kramer Cam. Jim is talking with the CEO of Hormel. You can catch that full exclusive tomorrow. I'm sorry, at the top of Mad Money in the next hour. Don't forget, you can have Kramer delivered right into your inbox with the CNBC Investing Club. Sign up now with all the info on your screen, including the QR code. Meantime, check out CVS jumping more than 4% to a brand new record today. Company announces it expects sales to accelerate as it rolls out new services in the new year. Over in the options pits, traders are betting that'll translate into even more gains for the stock. Mike Coe joins us now to break down the action. Hey, Mike.
Hi there, Carl. Yeah, so CVS traded more than 5.5 times its average daily call volume. Traders obviously making a lot of bullish bets coming out of the news that the company was offering there. The most active options were the weekly 100 strike calls. We saw over 11,000 of those trading for about 11 cents. That's a very cheap option, obviously about 0.1% of the current stock price. But what people are doing there is making cheap bets. The big move we saw today might continue tomorrow. And if it did, those would be a 10-bet factor. But I will tell you, there's probably a low likelihood that we're going to see moves that big, but we can see what they're betting on.
All right, Mike, thank you very much for that. Karen, another big buyback from those guys this morning. Although all retailers are sort of struggling with this new era of organized theft, and a lot of them are starting to lean on Congress to help them fight back on these marketplaces where you can sell stolen goods.
Yeah, that's been a problem for, we've seen it now from Target. We've seen it, I forget, there was another one last week. I don't know how we're going to solve, but that will obviously weigh on margins if some amount of your inventory you get zero for. So, I mean, however, they seem to have a great handle on their business, and Karen Lynch seemed very excited about, she is closing 900 stores, so they are going to be able to be more efficient, and she thinks without really losing any revenue. So that would obviously be a good thing. Also, they're focusing more on primary care, and she came from Aetna, so she knows obviously that side of the business well. All that having been said, at 12.5 times earnings, actually a little bit cheaper than that, I want to own low PE stocks, and I think this one's got momentum. And with the buyback, the dividend, they'll raise it a little. It's 2% now. I like the story. So also, last thing, 97 and change, there's a gravitational pull towards 100.
All right. Yeah, people like round numbers. For more options action, be sure to tune into the full show tomorrow at 5:30 p.m. Eastern Time. Up next, your final trades. Let's go around the horn. Tim?
Thanks, Carl. CarMax.
Karen?
CBS. Thanks for being here, Carl.
All right, Dan?
Yeah, Visa, growth at a reasonable price.
And Guy?
McDonald's, Q.
Thank you, guys. Thanks for watching Fast Money. Mad Money with Jim Cramer starts right now.
My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Kramer. Welcome to Mad Money. Welcome to Kramerica. Other people want to make friends? I'm just trying to make some money. My job's not just to entertain, but to educate, put it in context, teach. Call me, 1-800-743-CNBC, or tweet me at Jim Cramer. Let's talk about pain.
The house of pain.
Raw, nasty pain. Not the kind that stops with icy hot aspirin cream or even a morphine trip. That's just physical pain. I am talking about the kind of agony you don't get over. The pain of getting things wrong in the stock market. This is something that happens every day, including this one. Dow flat, S&P dropped 0.272%. NASDAQ nosedive 1.71%. But you don't care when it happens to the other guy. You only care when it happens to you. And I don't blame you. Today we convened our first CNBC Investing Club meeting. Oh my God, it was so much fun, where I pretty much bear it all. And I got to speak to a special woman who happens to live in my daughter's old stomping grounds of Talland, Oregon. She asked me about the stock of Boeing. Now, have you ever noticed how nobody's ever stumped on TV? They've already got some glib answer. And you know what? I'm the last person to criticize. I've been running a lightning round for 16 straight years. That's kind of the essence of off the cuff. But this one hit me hard. It had me struggle. It kind of had me blinded because the charitable trust has been pummeled by Boeing of late. Although we have a good cost basis on the stock, I am totally beaten down by this one. Really exhausted. This morning, I had to hear about how American Airlines would have to cut its flight schedules because it didn't get the Dreamliners it needs from Boeing. Why? Well, of course, it's the FAA, right? They see some problems with the planes. Problems, by the way, that management assured me would have been fixed more than 6 months ago. Given that this thing is delayed until late in the second quarter, we'll only be seeing these planes one full year after my sources told me not to worry about it. But my sources, they were good. They were. I mean, they said the problem would be fixed pronto. Meanwhile, China's recertifying the 737 MAX, the troubled airplane that was to blame for 2 accidents that killed hundreds of people. But this thing still hasn't been greenlit. And there are no new orders from Boeing's biggest customer yet. Given the political tensions, maybe there won't be. So what do you do in this situation? Now, part of me just wanted to tell Jolene that she shouldn't worry about it. The stock will be fine, right? And we always say that, right? I'll be fine. But stand back. Part of me wanted to say the whole thing's unfair. I mean, what does the FAA want? David Calhoun's head on the silver platter? If you gave him the CEO's head, would it make a difference? Oh, the gears were whirring in my head, especially steam wasn't coming out of my ears. I was just on the verge of saying, you know what? Enough already. Let me out of the house of pain. But then I recalled that just this morning, I had read a story and then saw the CEO, CVS, the drugstore chain, boosting its buyback, raising its forecast, setting the stock up almost 5% in a day. Now, what does CVS have to do with Boeing? Well, CVS is now up nearly $30 from where it was trading when the charitable trust bailed on it. We battled this one for ages. We were glad to sell it at a slight profit when if we had just been able to handle the pain of a story that we knew well, we could have crushed it. We always dreamed CVS would announce a buyback, but they couldn't because the balance sheet was so stretched from the acquisition. Well, it turns out we just had to be more patient to announce the $10 billion. We never dipped our feet into the promised land because we couldn't take the pain. It was just too much for me. Oh, and then I thought of Viacom. I mean, this is all happening when you're doing this thing. It's like, thought of Viacom. Now, that's a stock that got cut in half on our watch. I couldn't believe how we could be so wrong about the darn thing. They know CEO Bob Backes was doing a terrific job monetizing everything, setting up Paramount Plus for streaming. Franchises were making fortunes. But like CVS, we sold CBS, little network joke. We sold Viacom for the charitable trust, this time at the bottom. Why? Couldn't take the pain. Stock went up fourfold almost immediately because it never should have been down so much in the first place. I hate putting on anything on CBS ever since that, but sometimes Eagles play on it. So what I told Jolene in Oregon is that sometimes you just have to take the pain. Yeah, sometimes. Sometimes there's no choice. If you sell Boeing stock here, I think you will be kicking yourself, but I don't know when. I can't tell. Just like those of us who were foolish enough to sell CVS or Viacom because we couldn't see when the turn would happen. We couldn't tell. But let's step back for a second, though. I'm not a dig in the heels guy. I'm a discretion is the better part of valor person. So why have such angst about Boeing? Because while the short term is absolutely horrible, and I can't take being kidded about it anywhere, I think the long term is ridiculously bullish. That said, unlike so many other commentators, I freely admit that I've been very wrong. But you take the pain when you've got a real thesis. And my thesis here is real simple. First, most people on Earth have never set foot on an airplane. Now, that's a staggering fact, isn't it? We think of air travel as fairly commonplace, but most people in the world aren't wealthy enough to enjoy it. The thing is, that's changing. But just take China. In the last few decades, China's lifted 800 million people into the middle class. And they now view air travel as almost a rite of passage. Rite of passage for the non-French out there. Regular viewers know that I have huge problems with the Chinese government, but not with the people. I just think my view is no different, though, it turns out, than the current president or the last president. But you have to believe the Chinese will buy more planes from Boeing because they can't do without them. Which brings me to the second reason to own Boeing. There are only two companies on Earth that can make large commercial aircraft at scale. One of them is Airbus. Airbus is sold out. Boeing may have awful execution right now, but it's still part of a beautiful duopoly where they can charge an arm and a leg for the planes because they only have one competitor. Third, as Gary Kelly, the outstanding outgoing CEO of Southwest Air, told me this morning when I interviewed him, airlines that want to shrink their carbon footprint need to retire their older, less fuel-efficient planes. They also happen to be, by the way, noisier. And that means they need to replace them with new ones. You can't just keep using the same old aircraft. They do get used up. Now that big business is taking climate change much more seriously, almost every airline in the world has a fleet that's too old. They need Boeing. Finally, if you believe, as I do, that the pandemic's finally running its course, that the Omicron strain will be dealt with, then you have to expect a huge travel boom next year. There's no way you can. There's so much pent-up money and pent-up demand. The second great reopening should lead to tremendous air traffic, especially when travel restrictions are lifted worldwide. You don't have to quarantine. Now, I know there are a million opinions floating around about how contagious Omicron is, and how deadly it is, not as deadly as Delta, and whether the booster shots work or not. But I need you to start getting your arms around the concept of acceptable risk. Acceptable risk. That's what I'm looking for. We aren't just going to do nothing as we wait for COVID to get stamped out. You got two kinds of people when it comes to vaccinations. You either get all three shots, right? In which case you're basically fine, or you don't care whether you get sick in the first place. Either way, I think a surge in air travel will be the biggest change in this new hybrid work world. People want to go away and explore with Zoom, but therefore they can do it wherever they want. They can take off days, Zoom, go somewhere. Of course, some investors are worried that Zoom has killed business travel, which would be bad for Boeing. However, I think there will always be some business travel. What matters more, though, is that there simply aren't anywhere near enough planes right now available, at the airlines to meet all the demand. So these orders will be placed as soon as governments around the world say it's okay. And I have faith that the Boeing board of directors will do what's necessary to make the regulators happy. The bottom line, sometimes a company's long-term prospects are so strong that you got to be willing to endure the short-term agony when management screws up. And they are. But that's why it's worth it to take the pain in Boeing. Let's take some calls.
Hi, Jim. Thanks for taking my question. Do you think Apple can sustain its upward momentum in the face of the supply chain issues?
Well, I think it can. We just had Broadcom report a great number tonight, and Broadcom's one of the suppliers. And I know a lot of the suppliers they don't talk to about Apple, but they do say that they can meet the demand because they're prepped for it. They believe in Apple, and they know that Apple's going to want a lot of product. So I think they're fine. I wouldn't worry. Why don't we go to Josh in North Carolina? Josh.
Big booyah, Jim. How are you this evening?
Well, Josh, I'm doing just fine. We had a nice group of people on the club call today, so I'm doing good. What's happening with you?
Yeah, I really enjoyed that today.
Oh,
I'm
thank
glad
you.
you had that.
Thank you.
I look forward. Is this going to be a monthly thing?
Yeah, we do it every month. We got a great staff
good.
here. We're going to pull it off. Thank you.
Well, I'm a first-time caller, and I've been a member almost a year now. And my portfolio looks very similar to your charitable trust.
Oh, good.
I've got a DoorDash that, I've been holding on to it, and it's about 25 points down. And I want to get some feedback on you. I thought I read between the lines on something you said today about I felt like when it gets to a certain percentage and it's nothing, it's not like some of these big companies that maybe you should take the hit and reinvest the money.
Well, remember what I did say, though? I said these can
down.
bounce. Remember, what I've talked about was how I no longer like these companies that aren't making any money and are spending a lot of money and have good sales. That's not enough anymore. So what I am saying, although there'll be ones that do, I prefer an Oracle, which makes money up big tonight. I think you have to wait for a spike up in DoorDash to take any action, though. But DoorDash is defining exactly what I said in the club call. That's a very good read of the situation. All right, one of the best parts of our amazing CNBC Investing Club meeting today was the questions from members. Special thank you to Wallace from Maryland. Remember to head to cnbc.com/investingclub/live to see the whole CNBC Investing Club event today. A lot of links in my Twitter feed, too. Hey, by the way, thank you for all the nice comments about what we did today. Listen, I know being in Boeing hurts, okay? I'm sharing that pain with you. But for now, sometimes a company's long-term prospects are so strong that it is worth it to take the pain. Oh, man, tonight, Hormel jumped today on earnings. No pain there, reporting record spam sales 7 straight quarters. I'm taking a bite of the stock with the CEO to see if the company buying Skippy and my fave, Planters, could serve up some returns for your portfolio. Then earlier today, we held our inaugural CNBC Investing Club event. I had the opportunity to speak to Ford CEO Jim Farley. So I'm recapping my interview with the visionary leader and breaking down what we learned. And MP Mountain Pass Materials announced today it entered a long-term supply agreement with General Motors to provide necessary ingredients for batteries. And I'm discussing the deal with the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
It's spam time. This morning, we got a tremendous quarter from Hormel, the packaged food company you know as Spam, Applegate, Skippy, Peanut Butter, Planters, and a host of other brands. This is a stock that's been struggling earlier this year. Wall Street abandoned. Remember the packaged food place? They decided they didn't want them. They wanted the reopening stocks. But Hormel's now putting up some excellent numbers, maybe best in the food group. They gave you a top and bottom line beat, 32% organic sales growth, almost like a tech company. And management also issued solid guidance for next year. And this is a stock barely budged. That was wrong. Conference call was terrific. Stock caught fire, up nearly 5%. Even after this move, though, Hormel's still a fairly inexpensive stock. 2.3% dividend yield. Of course, they boosted the dividend. That's something that they've been doing forever. I think it's exactly what kind of a stock that can work in an environment where people are worried about a COVID outbreak and rate hikes from the Fed. But it's also a good place to have snacking at home. People are doing that with a hybrid economy. I'm thinking about this one for the CNBC Investing Club. Don't take it from me, though. Let's check in with Jim Snee, the chairman and CEO of Hormel, to get a better read on the quarter and what he sees going forward. Mr. Snee, welcome back to Mad Money.
Hey, Jim. How are you? Thanks for having us. We're coming to you live from the Spam Museum in Austin, Minnesota.
Well, there you go. I've always wanted to visit the Spam Museum. I take my wife there. She's a Spam backer from a long time. I happen to have, by the way, the pumpkin Spam on my set. Nothing like that. Probably still selling well, correct?
Absolutely. I mean, Spam in general is selling well. We just announced earnings today, and we had our 7th consecutive record year of Spam sales. That's incredible. And we've had to announce new capacity that we're going to bring online in 2023 to meet the demand. So Spam's as strong as it's ever been.
What's incredible to me is that everything's as strong as it's ever been. Every single line you have, every acquisition you have made. And this is despite the fact that I'm quoting you, labor rates, freight, supplies, raw materials all remain above year-ago levels, and yet you still delivered. How is that possible?
Well, I mean, as you know, Jim, it's a testament to our team. And our supply chain team has just been doing heroic work up and down the supply chain. You know, we've had countless interruptions. We've had packaging materials, ingredients that haven't shown up, trucks that we haven't been able to ship on time. But in spite of that, we've found solutions. We found ways to create solutions. And at the same time, our sales and marketing teams have done an amazing job creating that demand with the consumer. And so, I mean, as you said, you go across our entire portfolio, every channel, every segment, whether it's retail, food service, deli, international, just really, really strong growth. And I would say that in some ways, this pandemic has brought out the best in us because we're collaborating and working together as a team better than we ever have.
Now, at the same time, you've had to integrate a gigantic acquisition, one that and I'm holding some up, the Planters acquisition, an incredible brand that had been completely undermanaged. And now you've integrated one of the 3 plants. How's that going?
Going really well. It's performing on the high end of all our expectations, Jim. You know, as we think about where we're going to take that business in 2022 and beyond, I mean, we're having conversations with retailers and customers that we've never had. So we've really been able to amplify our snacking voice. I mean, you can see from our portfolio a number of snacking items, but when you add Planters and the scale that brings, changes the conversation. It's also introduced us into the convenience store channel in a much bigger way. And that's exactly what we thought it would do. So as we look into 2022, again, we expect it to perform on the high end of our expectations that we announced when we bought the business.
Yep,
We've also got some great new innovation, marketing, packaging redesign, new flavors coming to market. There's a lot to be excited about with the acquisition of Planters.
But I think people should know, despite the fact you had to spend a lot of money to acquire that, and you stretched your balance sheet a little more than I would have thought, but I think it was the right thing to do because it's very rare that something like this comes up. You still managed to increase the dividend, of which many of our viewers are most grateful for.
Yeah, I mean, we've had an amazing run. Obviously, we're considered a dividend king. We just announced our 56th consecutive year of dividend increases. And, you know, it's one of the things that when I took this job 5 years ago said, I'm not going to be the CEO who breaks that string. And so we know how important it is to our investors, but it's also equally important to maintain that strong balance sheet. And we've been able to do that even with the acquisition that we made of Planters. I mean, we're ready to go. We have a lot of optionality if we want to make another bolt-on acquisition, investments for capacity, investments in other parts of the business. We can do anything that we need to do with the balance sheet that we have.
Yeah. One of the things that I thought was interesting is you kind of represent what I see in America today, which is that the actual commodities that you're starting buying are starting to go down. It's all this other stuff. It's all the freight. It's all these things to get the stuff to the store, to get it to you. That's where the real inflation in this country is, isn't it?
Yeah, it really is. I mean, a number of our inputs have started to moderate for a number of our products. But I mean, when you think about the labor increases that we've had, increases in our packaging, other supplies, getting the product shipped, as you mentioned. I mean, that inflation it's real, it's significant, and it's being passed along in the form of higher pricing.
All right, one last question. What is the hottest thing you're selling right now? What is the snack food for the hybrid economy where the kids are home and the people in their 20s and 30s are working from home, not going to work? What are they?
Well, like I said, our planters business is incredibly strong. Our Columbus charcuterie, as families come back together, is a perfect item. So, I mean, as you look across the entire snacking portfolio, Jim, it's not just any one item. We got a portfolio to meet every family's needs, and we're excited as these holidays are around the corner and families and friends get back together. We're there for them.
Well, there's something for everybody for Hormel. We are gigantic planners people. What a fantastic move. But there's so many other good ones. I want to thank Jim Snee, Hormel Food Chairman, President, and CEO. Makes it look easy, but it's actually really hard to do. Have a great holiday season, sir.
Yeah, happy holidays, Jim. Thanks for having us.
Thank you. Stay up there, buddy.
Coming up, Kramer hosted the CNBC Investment Club for an up-close and personal and profitable study session. Find out what the club learned directly from Ford CEO Jim Farley. Next.
Let's talk about one of the greatest turnaround stories of our era. Let's talk about Ford Motor. I like this one so much that we own it for the charitable trust, where it's been one of our best performers. We initially started our position at $9 a little over a year ago. Now it's at $19 and change. And if you want to know what's driving that move, it's because the relatively new CEO, Jim Farley, has orchestrated an incredible comeback. Yep, last year, Ford finally brought in a real car guy to run the company. His first order of business was to run the company like a for-profit enterprise. See, in the old days, Ford was more committed to building cars everywhere in the world, kind of a statement, even when they couldn't make money. Well, yeah, in a lot of places. Under Farley, though, the company's committed to making money in every market they participate in, or else they'll leave it, and every car and truck they build, or else they won't build them. Every one. More recently, he's made a massive push into electric vehicles. Earlier this year, Ford rolled out the all-electric Mustang Mach-E, sold out immediately. And by the way, they make money on every one of them. And they've got a huge lineup coming next year, including the electric F-150 Lightning pickup truck and an electric commercial van. Behind the scenes, management's also been working to arrange long-term supply agreements for the semiconductors and the batteries that the whole industry desperately needs. It's going to be a dogfight there. They've made savvy investments, too, taking a stake in Argo AI, autonomous driving technology coming, not to mention their position in Rivian. What a windfall. The newly public electric vehicle maker, which is now worth $12 billion, their stake alone. Now, earlier today, we got a chance to speak with Jim Farley as part of the CNBC Investing Club's regular conference call. Now, if you want to see the Investing Club's whole thing, of course, you got to join the club, and I'm urging you to do so. Here's what you have to do. You can go to cnbc.com/investingclub/live. Wow. Okay. There it is. But this was such a great interview that I thought I should share some of the highlights with you. Now, what makes me so confident that Ford Motor is doing well, even in the face of the semi shortage that's kept the lid on production? Well, some of it's because the company's latest quarter was strong. By the way, added a dividend. More importantly, though, in late October, what they're doing is kind of reorganizing and making it clear that they can do even more dividends than just the one they've done. Why? Well, why don't you listen to Farley's reason?
Our business is getting a lot of momentum now. The company's getting healthier. So we thought it was the right thing to reinstate the dividend. We want to go higher. And our cash position is great. You know, we have incredible demand for our product. We have the green bond that came out. We've lowered interest rates. We took on a little more debt during COVID, and we're now paying that very expensive debt back. So our balance sheet looks good, and we're going to go as deep as we can to reward our shareholders.
In the old days, Ford used to have a gigantic dividend. Then they had to get rid of it. Maybe they can bring a lot of it back. But how about this huge push into electric vehicles? That's the kind of thing I really care about. Why don't you listen to this?
We're completely oversubscribed with our battery electric vehicles. Lightning especially, the F-150 Lightning, America's best-selling vehicle. Everyone loves the electric version. They haven't even driven it yet. Where do they drive it? 0 to 60 in like a 911. It's just an incredible product. It powers your house for 4 days. We had to stop reservations. We've got so many.
Powers your house for 4 days? I'll take that. Remember, the F-150 is indeed the best-selling vehicle in the country for the past 4 decades. That's right, 40 years. And I think this electric version, more than anything else, is what will allow Ford to mount a serious challenge to the only major player in the space, Tesla, and to actually make a lot more electric cars than GM, although GM's doing a lot of right things, too. But can Ford really compete with the all-powerful trillion-dollar Tesla?
We have to scale our electric business so that we are competitive with them on scale or beat them in more profitable segments like pickup trucks and commercial vans. And we have to make money on those vehicles. The scaling is the first part. We have a roadmap. We now have the talent in the company, like Doug Fields, who came from Apple and Tesla. So we can do this, but it has to be both.
Yeah, Doug Field being the guy who was running the Apple electric car business. That was a real nice pickup by Jim Farley. All right, make no mistake, Ford is aiming to win. Or as Farley, who races cars in his spare time, says,
second place is the first loser. That's how I look at business. Ford employees deserve the best leadership, and our investors are betting on this company. So, yeah, you should expect us. As we go battery electric, we can really reinvent the brand. And we're doing that with F-150 Lightning. We're already seeing it. Now we have to develop a lot more vehicles just just that good and build them and do it profitably.
Second place is the first loser. I'm going to use that for everything I ever do in the sports world from now on. Okay, right now, we've got a supply chain crisis in this country, and the auto industry has been one of the hardest hit areas. So you have to ask yourself, can Ford really come up with the materials they need to launch their massive new electric vehicle lineup next year? And that's the big complication. Sure seems like the answer is yes. Listen.
We can put more shifts of workers on. Our UAW members are ready to make these vehicles. We had to find batteries. That's in the middle of what we're doing. As big companies, we're not used to committing to stuff that we don't have all the answers to. But, we think we can do it. In 24 months, we're going to double our capacity for these battery electric vehicles. We're well on the way of doing that. We've gotten a lot of incremental battery commitments out of our Georgia facility, and we really think we can do it. And my name's on the line.
If they can really double their capacity for electric vehicle batteries in 2 years, that's huge for Ford and huge for you if you're a shareholder, huge for my charitable trust. And Ford's adamant that they can do it.
Don't bet against Ford when we have to increase capacity. This is what we do.
What about Rivian, the electric vehicle company that recently came public with a bang? The one Ford's got that 12% stake in. Ford originally had joint plans to develop electric vehicles with these guys, but that plan's been scrapped. Farley, uniquely, though, doesn't sound threatened at all. Listen.
We're really excited, actually, about Rivian. It's a great American company. You can argue about what it's worth versus what Ford's worth, but I really like the talent over there, and I like their positioning of products. They're going after pickup trucks and van owners, and we like those kind of people. They're hardworking Americans who want to make this transition to electric.
Well, Rivian's come down big from its highs. It's still nearly a $100 billion company. Just remember, again, Ford still owns 12% of that. Well, I wouldn't be surprised at all if they eventually sell their stake down to zero, frankly, because it's too dicey owning shares in a competitor because they need the money. But the bottom line, I feel confident about Ford because the newest CEO, Jim Farley, has already done a magnificent job of turning the business around and really aiming for profitability, not just world domination. The guy's a real straight shooter, and having spoken to him earlier today, and I urge you to join the club and watch this whole interview, he sure sounds very confident about the future. More importantly, betting against him has proven to be a serious and a costly mistake. Remember to head to cnbc.com/investingclub/live to see the whole CNBC Investing Club event today. It was just amazing. And we got some incredible members from you, and I love it. Remember, questions for you. I have to tell you, the questions from the members, the best part of the show. So many that we were not able to get to all of them. So let's take one of those calls now.
When I received the updates on purchases, I noticed that you mentioned the percentage of the portfolio the asset represents. How do you determine the allocation percentage of each asset in your portfolio? Thank you.
Thanks, Jim.
Thank you. Great question. I like to do, I tell you, this is something in Bob Michelle from my home state of Pennsylvania, by the way. What I like to do is not have any one stock be able to control the direction of the fund. So let's say today, we had a stock that was up, say, 25%, and our whole fund therefore swung, say, 15. We're too correlated and too big. Hardest way to be able to cut back, though, is to have to sell a great stock. We don't want to have more than, say, 6%. In an individual stock. It's a discipline. Discipline always trumps conviction. So we do a little selling when that happens. Listen up. I'm bullish on Jim Farley, and I'm bullish on the Ford Motor Company. It is one of the greatest turnaround stories of our era, and it's just not heralded enough. Now let's work for money, including my exclusive with MP Materials, announcing plans to build a magnet factory in the U.S. I'm hearing more about the rare earth materials company with the CEO. And by the way, just so you know, that's what you need to make the batteries that Farley covets so much. Then we're in the midst of an enormous housing shortage, and I'm helping you set up your playbook on investing in the space. And of course, all your calls rapid fire tonight's edition of the Lightning Round. So stay with Kramer.
We can put more shifts of workers on. Our UAW members are ready to make these vehicles. We had to find batteries. That's in the middle of what we're doing. As big companies, we're not used to committing to stuff that we don't have all the answers to. But, we think we can do it. In 24 months, we're going to double our capacity for these battery electric vehicles. We're well on the way of doing that. We've gotten a lot of incremental battery commitments out of our Georgia facility. And we really think we can do it. And my name's on the line.
Wow. Well, how do you play that? How do you play the ramp up in electric vehicles that's going on everywhere? Why not work your way up the supply chain with MP, that's Mary Peter Materials, the largest producer of rare earth minerals in the Western Hemisphere, a huge differentiator in an industry that's dominated by, yes, the People's Republic of China. You need these rare earths to make electric cars and trucks. It's just the way it is, just today, though. We learned that MP Materials is moving up the value chain itself, building its first rare earth metal, alloy, and magnet manufacturing facility in Texas. And they've also signed a long-term supply agreement with Ford rival General Motors for these same materials. This stuff is essential for EVs, and that's why the stock jumped nearly 3% today. I wouldn't be surprised it's got a lot more room to run. So let's take a closer look with James Litinsky. He's the chairman and CEO of MP Materials. MP is actually Mountain Pass, as you know. To learn more about where his company's headed, Mr. Litinsky, welcome back to Mad Money.
Hi, Jim. Thank you for having me back, and it's great to be here on a special day for you. Congratulations on your first day of Investing Club.
Well, thank you. We talked a lot about EVs with Jim Farley. Now, obviously, Mary Barr has got this great deal with MP, but it is very clear that in many ways, your company holds the key to what could be the bottleneck. And I want you to tell our viewers how important what you just did today was, because when I first met you, this was my hope, and you really delivered.
Thank you, Jim. That's nice to hear. And that's absolutely it. We think that the upstream is the key to the electrification. As we go through this transformation, there's a lot of industry of the supply chain that needs to change. And when you look upstream, there just isn't enough stuff for everybody to compete. And so we think that the electrification race is going to be won upstream. And today was obviously a transformational event for MP Materials. As you know, it's been our mission. So, yeah, go ahead.
Well, at the same time, you got this agreement, but the numbers themselves were fantastic. Your revenues increased gigantically. Net income is amazing. But to me, the plant that you're opening and the way you're going to be able to execute any sort of arrangement where our country's beholden to China, because if you're beholden than we are really rather remarkable. Please lay out the next 4 years, because people won't believe what you just accomplished.
Thank you. Well, first, a lot of the credit really goes to GM for having the confidence in us, the commitment to see what is really happening out there in the landscape and wanting to be one of the leaders in going upstream in this space. And so, we have a long-term commitment with them. We've got to execute, but we think it'll be very attractive for our shareholders and a great partnership. It'll be great for GM. It'll be great for the country. We're going to get this supply chain home. As you know, about 90% of this supply chain is in China. It's a single point of failure for the industry, and the downstream is realizing that this needs to change, and so we're leading the way on that front in our area.
So, is our country doing enough? Is the government doing enough to recognize that once again the Chinese have an edge on us, and we've got to make this so that it's just not sustainable if they own the rare earth market?
Well, I think that the private sector needs to solve this problem. There's a lot of capital available downstream. And so I think what you're going to see is that the first movers like GM today are going to be the ones who are able to produce 3, 5, 7 years out. And so I think when you look at the street numbers for electric vehicles, what you're going to see across a lot of these commodities, and whether it's semiconductors or different pieces of the upstream, there's just not going to be enough for everybody. And so I think it's going to be a private sector solution. The government can certainly help, and it's welcomed. But this is a race, and today was a key first shot, so to speak.
The previous company that, of course, didn't make it, that you made it, took over, always told me that Mountain Pass is huge. I didn't know it is the world's second largest rare earth production site. So that will give our country multiple years of the materials we need.
That's right. Well, we're the second largest producer in the world. And Jim, as you said, you can look at our numbers. We're profitable today, just selling an intermediate product. And it's really remarkable what's happened out there. I think people would also be amazed at the magnetics team that we've built, and it's an extraordinary opportunity. And so we'll continue to execute at Mountain Pass, and then we'll move downstream into magnetics, starting with GM today. And we'll continue to grow that business. And there's just, there's a lot of open space. This is a huge growth opportunity.
Okay, so we don't know the actual financial terms with GM, but this is important.
That's right.
I would not blame you one bit if you did what Lucid did today. Lucid did a $1.7 billion convert, raised more money, did hurt the common stock. I mean, I want you to be big. I think it's perfectly reasonable to ask, with these ambitions, isn't it time to raise money, maybe through a bond or common stock?
No, well, Jim, we have $1.2 billion of cash on our balance sheet. We have nearly $500 million in net cash, and we actually said today that we believe we'll make this first facility with the net cash, comfortably with the net cash on our balance sheet. And so we are positioned to do this. And I think it's also very important. We've sort of said from the very beginning that as we move downstream, we don't rob Peter to pay Paul, so to speak. We have a very exciting stage 2 opportunity, which is producing separated rare earths. This magnetics business, we believe, is a high return on capital, an incremental high return on capital event for shareholders. And so, we're going to keep moving forward on this. And by the way, this facility represents sub 10% of our NdPr oxide expected output. So we believe this is a multi-billion-dollar opportunity, and again, multi-billion-dollar supply chains don't move overnight, but we're moving methodically.
Well, you delivered. I know at times I've been skeptical, and I've shared that with you, but you delivered.
We appreciate it, Jim. Keep holding us to account. We have to execute, and we'll keep at it, and we don't mind the criticism. We just continue to execute.
That. You always stand up, and you delivered, and I want to congratulate you. Great job, James.
Thank you. I appreciate it, Jim.
Chairman and CEO of MP Materials, delivering on everything he said he would when he first came on the show. That money's back into the break.
Coming up, a storm is coming. So give us a call. Kramer's got the answers to all your burning questions. The lightning round is next.
It is time. It's time for the lightning round. And then the lightning rounds are you ready? See, let's start with Desmond in Indiana. Desmond.
Oh, hello there. This is Mr. Kramer.
Yes, it is, Desmond. How are you?
Oh, I'm fine, thank you. Say, my question has to do with an IPO that you recommended some time ago, Royalty Pharma.
Yeah, I can't believe, sir, how low the stock is. I mean, honestly, I just actually checked in with the sponsors of this. This company is doing so well. I really don't know what to say. It is doing incredibly well. They ought to be able to raise the dividend, but they own stakes in a lot of different drugs. I would want to stay long this stock. Tom in Connecticut. Tom.
Booyah, Jim. Tom
Booyah,
from
Tom.
Connecticut here.
Booyah.
Hey, we've been watching your show for a long time. We're a member of the Investment Club and saw the Investment Club show today. It was great. Looking forward
thank
to
you.
more.
Thank you, buddy.
All right, man. Down to business. Canadian Pacific Railway. As you know, they're looking at a merge with KSU. If the wheels don't fall off the deal, there'll be a dominant player between Canada, the U.S., and Mexico. My question is, do you think they're a buy, hold, or a sell?
No, it's a buy. I think it's the laggard in the group because of the transaction. I mean, obviously, you've seen what we're doing with Union Pacific in the club. It's been such a monster. I think that railroad will be kind of playing catch up to UNP. Let's go to Dennis in Florida, please. Dennis.
Jim, thanks so much for taking the call. Greatly appreciate it. Appreciate all your hard work.
Thank you.
Very welcome. Calling about ticker symbol DAC, Denhouse.
I'm not going to recommend container ship stocks. They are, in the end, look, no offense, but I mean, these are ones where I can look so great or so bad, and I'd rather just go with something consistent because they are the ultimate commodity. And, there is one from Norwegian that is actually too little to even mention on air. Now, it's a different kind of tanker, but in the end, they trade like a unit. I need to go to Mark in Florida. Mark.
Hi, Jim. I enjoyed the Investing Club presentation today.
Thank you for attending. Thank you for being convenient, for being this for the first convention.
My pleasure. My question concerns Standard Lithium, a company that produces the key component of lithium-ion batteries used in electric vehicles. I started buying it at 1046 and have been buying more as it came down. Where do you think it's going from here?
Well, I think you can go higher because parts of the battery are really in obvious demand. But I'm sticking with my new fave, MP Materials. One more. Let's go to Ed in Ohio. Ed.
Yeah, boo, Chili Jimmy.
Yeah,
this
man,
is
what's
Fast
up?
Eddie.
Yes, that's
in
me.
Berea, Ohio.
Okay.
I'm an Investing Club member, and I find the email newsletters very insightful and valuable. Thank you.
That morning one I do is just I start that one at 4 a.m. What's going on?
My question is Ionis Pharmaceuticals, IONS.
Doesn't have enough juice for me. Never really started making a lot of money. I just can't recommend them. I can't. I like the ones we talked about in the club a lot more, sir. Thank you, everyone, for being part of that call today. And that, ladies and gentlemen, the conclusion of the Lightning Round.
The Lightning Round is sponsored by TD Ameritrade. Coming up, hot, Mike. Make sense of the day's most critical market machinations in no time flat. Stick with Kramer for a special no huddle next. Tomorrow, kick off the trading day with Squawk on the Street. Live from Post 9 at the NYSE.
Guys, I wanted to talk about cable and telecom. We talked a bit about it yesterday.
Oh, we've been upbeat the whole show. Now you got to bring that up.
Your whole posture just went. It's a favor report. I haven't done one of those in ages.
Are you doing
Where's Johnny
Charter?
Gilbert?
Are you doing
Introduce me.
Altice? Are you doing
Yes,
today?
doing all of it.
It all starts at 9 a.m. Eastern.